Good afternoon. Welcome to the August 3rd, 2022 version of the Traders Exclusive Live Strategy Series. We've got 4 great experts with us today. We've got a cool strategy for day trading SPY options. We've got a perfect strategy for small accounts, an amazing strategy for trading futures, and a simple strategy to instantly help you get in and out of trades at the right time. Please check out TradersExclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find a recording of today's webinar. Before we get started, I'd like to share a quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations, especially presented here, are subject to change at any time. Past performance is not necessarily indicative of future results. Please take notes and write a little bit of context to your questions and hold your questions until each presenter is finished. And I want to introduce our first guest, Hugh Grossman of DayTradeSPY. He is going to be talking to us about SPY options. Are they right for you? Hugh is an ordinary guy who discovered 3 very important things the day he got burned by his financial guru. Nobody cares. Number 1, nobody cares or should care more about your money than you. 2, with the power of the internet, anyone can have full access to information just as much as your financial advisor. And 3, don't be the victim. Take responsibility and seize control of your own life and future. Thank you so much for being with us. Hugh, take it away.
No problem. Sherry, quick question. Can you see my screen okay? Everything okay?
Can you hear me okay? Screen, yes. Good job. Okay.
Awesome. Everything's working. Great. Well, hi, everybody, and good to have you here, and good for me to be invited here. Thank you very much for that, Sherry, at Traders Exclusive. It's been a long time since I did a little segment here with you, and I really appreciate it. And it's very exciting. So let's get to it. I still see people joining us here, but I guess they'll catch up, right, Sherry? They'll be caught up, so not a problem. It is being recorded.
We're going to have a replay.
Yep, there you go. Perfect. All right, gang. So there's a questions box open, I believe, for your questions and comments. Just click on that, and if you have any questions, if we have time, we'll certainly get to them. So my name is Hugh, and thank you very much for that amazing introduction here, Sherry. Yes, ordinary guy. I used to be in corporate America, okay, and but before we get going here, I just want to say I'll give you a little bit of a background on myself a little bit here. So SPY options, are they right for you? We understand it's not for everybody, but pretty well everybody I talk to really likes it. My name is Hugh, and here's the standard disclaimer I have to put on there because the lawyers, we got to keep them eating too. I don't know why, but they have to eat as well. So by attending this webinar, you fully understand and accept the financial risks involved in trading securities. Risk of loss can be substantial. You should carefully consider whether such trading is suitable for you in light of your personal investment objectives and financial resources. You understand too that you're not receiving any advice as to what or when to buy or sell, but are simply receiving information for educational purposes only. Any decisions concerning your trade are solely your own and meet your personal objectives and risk tolerances. You alone are responsible for all your own trading, and past performance does not guarantee future results. Charts, by the way, are courtesy of TD Ameritrade Thinkorswim. So here's what I want to talk about here this afternoon. First of all, choosing a quality stock. I think this is really, really important. Learning market behavior. Once you understand this, then you can go on to step number 3, leveraging a solid strategy in which you can make some serious money. And then we've got a little exclusive offer for you. I think you're going to really like this. And let's get started here. So first of all, a little bit of a background on myself. I don't think anybody is born a trader. I don't know of anybody who even in high school said, I want to be a stock trader. Well, I think there might have been 1 or 2, but I don't think anything ever happened to those guys. But I kind of fell into it. I guess I was coerced into it. Like the good salaried employee back in the day, I used to be an internal auditor for a major insurance company, a Fortune 500 company. And I used to, go to work, get my salary, and hand off a lot of it to my financial guru to invest in my retirement. My good friend Mike, of course, they're all your friend at the time, right? Because they're going to take care of you. And the irony of the whole thing is, I never bothered to open up those envelopes they used to send me every few months. I thought, oh, that's my future. That's retirement. I'm sure I'm going to be really pleasantly surprised when I open it up. I see the millions of dollars, and I can retire very nicely, and all is cool. Well, one day I thought I better open up this envelope and just see how much money I do have in there. And then I saw, oh my gosh, I only have about half the capital I put in. what's going on? Okay, it's my fault. I should have been on top of this guy, whatever. I called him up. I said, Mike, what's going on? Well, he realized he'd been caught, right? And he's trying to keep the account, and he's begging me, oh, and this is the time to average in and all this stuff. The stuff he's telling me. And I said, oh, Mike, at this rate, I won't have a penny in no time. Leave it to you. And I don't care why. It's not my, you were entrusted to take care of my financial. Anyway, long story short, I told him to cut me a check for whatever is left. Obviously, I have to learn how to do this myself. And it was a very emotional day. I did go down and pick up the check, and I remember driving home. I was very heartbroken about this whole thing. I thought, you know what? Okay, fine. I get it. The way I am, my life is going right now, I'm probably going to be pouring coffee at a coffee shop in my retirement, and that's fine. It's okay. I like Dunkin' Donuts at the time anyway, so not a problem. But what really struck me was my kids' education, and I thought to myself, you know what? I am going to do anything and everything it takes that my kids are not going to go uneducated and being crippled for life in this day and age when I need that to happen. When they need to have a skill. And I'm going to provide that for them. If I have to sleep in a tent, I'm going to do that. So I had what little was left in my account, and I decided to get some knowledge. And that was the time when there were a lot of, at least that's when the time was when I had been sort of exposed to a lot of these discount brokers or ads on TV and money shows coming up in various shows, right, trade shows. And so I started going to some of these things, and there's so much out there. Holy smokes, all these different courses. And I started taking a lot of these courses, and but I noticed a couple of things. A lot of these people they would always upsell you, and it was all very nice. And I took a lot of these courses, and I spent a lot of money on these things. But I would take home the DVDs and the books and everything else, but it just didn't fit for me. I couldn't get it to work the way it did with the presenters, and it just wasn't the right fit for me. And I spent fortunes on it. But I knew there was money in this business, because I would spend hours and hours and hours on end poring over charts and indicators and stuff. And I remember my wife would come into the office and say, what are you looking at? You've been there for the last 5 hours. You haven't moved. And so, yeah, I said, take a look at this. Every time this happens and this other thing happens. And if you go back, months or years or whatever, every time this one event happens, this other thing happens. And imagine if you can just, let's say you invested here and you get out over here, how much money you could make. And so anyway, I'm going through all this, all of this. And then eventually I realized, yes, options is the place to be. And I started out like everybody else, I'm sure, with equities, but I got into options with different companies, and I made some money, and I lost a lot of money as well. But I always took away a lesson whenever I lost money, especially when I lost money. Then I discovered SPX, the top 500 stocks, like the basket of the top 500 stocks. I thought, well, that's kind of cool. And then I got into SPY. And that's when I really started to make some serious money. And then I started to bring home the toys. By the way, at this point, when I started making some pretty good money, I had to pretty well quit my job because my heart was no longer in it, and things started to really move forward. And I started bringing home the toys. New cars, new vacations, new house, new airplane. I like to fly, so I bought a new plane. And people started asking me, Hugh, what are you doing? Well, I'm trading options on SPY. Well, can you show us? And that's kind of where everything started. Now, that was back in I've been trading for years before, but I actually started the business in 2010. So we are now in our 13th year doing this, 13th year. So that's kind of my background. I love teaching. I don't have to teach if I don't want to, because I make my money mostly trading, but I love to teach. I love to meet, and I've been meeting the nicest people from literally around the world. And we have trading rooms, and we have people from around the world coming into the trading rooms every morning. And anyway, things are just great. But what I really love is, showing other people how to do it. And I probably derive as much, if not more, pleasure out of that, because I sense that I'm making a difference down the line. And I really get excited when our clients show their kids, their adult kids, how to do this. Speaking of which, I have a son and daughter, both adults, and they know how to trade. My son, he's an engineer, but he trades. And I think he makes more money trading than he does working. So now my daughter, that was pretty funny. She graduated from college in marketing, and And after her university days, she says, well, I want to go teach English as a second language in Thailand. Now, you have to understand, my daughter never seemed to have that travel bug in her. I mean, we used to kid her. We used to say, oh, you're going to go from, you're going to go from Buffalo to Rochester, oh, which is an hour down the road. Oh, who's your travel agent? We'd always joke about it with her and stuff. But I didn't believe it until she actually got on the plane and moved to Thailand for a year. Completely different culture, language, everything. And of course, we still communicate all the time. And I would say to her, how are you doing for money? So I'm fine. And then she traveled around in different countries there, Myanmar and Vietnam and different things. And I'd always say to her, Lex, do they pay you that much teaching? Oh, no, I'd starve to death if I lived on that. Well, how are you making money? I said, well, you taught me how to trade SPY. That's all I do. The American dollar goes really far down here, and this is what I do. So if I need any money, I just go to the stock market. So, oh my gosh, that's very liberating for me, right? So after about a year or so, she came back and she was very experienced and she loved it. And then what did she do? She said, well, I'm going to go to Peru now, do it all over again in Peru for a year. Peru, oh my gosh. All I'm thinking about is, Escobar and all these guys. And the same thing, whenever she needs money, she goes to the stock market. And it was a very, I don't know how to explain it. You cannot explain the feeling that when you know your kids have the ability to go to the stock market and get the money they need for whatever the things they need or want. It's kind of like trying to tell a blind person what color is. I felt so relieved, like I don't have to worry about you anymore. You know how to go and make money yourself. That is such a cool thing. Anyway, she's doing great. My son's doing great. And this is what I like when other people, some of our clients, they show their kids how to do it. I really get a charge out of that. So anyway, started doing this and people started asking me, and hence the business just blew up like crazy. And it's been great ever since. Now, folks, I know there's probably some people here who've never heard of options, don't know what they are. Generally speaking, they're contracts that the options holder enables you to trade the underlying stock for a certain price by a certain date. Don't worry too much right now if you don't really understand a lot of this. Just know that options have amazing leverage. They have all kinds of great benefits, and they also have some obligations to them and some risks. So, but right now, instead of going through all of that as a primer, what I'm going to do is anybody who is so new to options that really doesn't know what these things are, just know that they are the greatest tradable instrument out there as far as I'm concerned. And if you would like, I will give you a complimentary one-on-one session to kind of bring you up to speed about options. So all you have to do is just go to our website, DayTradeSPY.com, and go through the contact us and just book a one-on-one session with me. I'll give you 15, 20 minutes on that, bring you up to speed, and you can pick it up from there. And I think that's a really good way of doing it. So, but I'm guessing that probably most people online here do know what options are. So, all right, so the number one things I mentioned here, first thing, it's about choosing a quality stock. Now, I know a lot of people are attracted to certain stocks for certain reasons and options and whatnot, and I think we all do. And I remember when I started out, I would trade, Starbucks because I like Starbucks. I used to get their coffee, or I would trade, Coach because my wife likes Coach purses. Those were all the wrong reasons. Or I would get into penny stocks because they were cheap. Again, all the wrong reasons. Let me tell you, maybe there's somebody making money on penny stocks, but I can tell you horror stories about that. Choose quality stocks. Very, very important. You want to choose something that has some level of stability and affordability, predictability, profitability, enjoyment. When I say affordability, I mean, if you were to buy stocks, a lot of stocks now, they're just simply out of the realm of most people. When they cost hundreds of dollars a share, there has to be quite a move on the stock to make any money. And that's not always easy. So, but with options, you actually have this amazing opportunity to get in and control underlying shares for a very, very small price. And that's what I really love about it, because just about anybody can get into this thing. You want something that's, look, I don't want to say it's stable. There's no such thing as easy or simple or stability in the stock market. You need to know that, which is the reason you need us. All right. But some stocks are simply better than others because they have that characteristic that they're pretty predictable, they're pretty reliable, they're pretty stable in certain situations. And that's what we provide here with SPY. That's what SPY gives us here. It has to be enjoyable too. If you're not enjoying what you're doing, then you probably shouldn't be doing it, especially trading. So to find what that was, one stock, one strategy, 1 hour a day, I discovered it was actually SPY, which is the stock. It is actually called a spider. It's a stock that follows the S&P 500. So pretty well where the economy goes that day, that's where SPY's going to go, which makes things a whole lot easier because now you don't have to look at the individual stocks and see, well, who's managing, what are their new products coming out, what are their copyrights, what, is, Steve Jobs, when he got sick, all of a sudden Apple went down, but when he died, it didn't. I guess the market already expected it. I've seen situations unfold where the CEO is sleeping with the secretary and the stock goes, it's crazy. And then you have to look at sectors, right? So before this, I used to be involved with other groups, and that's what we used to do. We have to, we spend all our Sunday nights, Monday nights, Tuesdays, Wednesdays, Thursdays, probably about 15 hours a day, we were preoccupied with trying to find stocks that are going to move in our direction. And that was really all consuming. I loved it, but after a while, my wife says, this is all you're going to do all the time. Well, I don't know. It's not going to really work out too well. You have a family here and stuff. And I said, yeah, I know. Anyway, I found SPY. And now what I do is I just get up at about 8:30 in the morning. I come down, open my computer. I get a pretty good idea as to what's going on with the economy, what's going on with the market today. And I can pretty well predict where the stock is going to go today. I have no clue where it's going to go a week from now or a month or a year from now. But today I have a pretty good idea where it's going to go. I don't need to know where it's going to be a week or two or a month from now. But if I have a pretty good idea where it's going to go today, I can usually make some pretty decent money. Now, something else I should tell you, that over the last 12 years, we know how to trade and how to train. We did learn a few things along the way here, folks. So therefore, you are going to get the advantage because you're going to learn from all those mistakes I made, we made in those years, and best that you learn from us because you're not going to simply live long enough to make them all yourself. Notice that the smart person knows, learns from their mistakes, right? The smart person learns from their mistakes, but the wise person learns from other people's mistakes, right? So anyway, you have a very distinct advantage in that you are right here on this webinar listening to all this material right now. I wish I had a Hugh back in those days because I would have saved myself an awful lot of money, time, effort. Oh my goodness, I would give anything to go back and do that. Folks, I got to tell you, we day trade options on SPY, period. That's all we do. I don't get involved in any other stocks. I don't care. I don't care where Google's going or Apple, Microsoft. None of that matters to me anymore. SPY. It is the highest traded stock out there. It's affordable. It's liquid. That means that I can get in and out of trades easily. I don't have to wait for a buyer to show up. I don't have to knock on doors and say, will you buy my options? None of that, none of that. It's just the most amazing, exciting, and hugely profitable, potentially speaking here, stock out there. I absolutely love it. And after all these years, I'm still very excited to trade SPY. I had never had one day of boredom with this stock. I've never seen anything like it. And it's as long as there is a SPY to trade, I will be in the market. I will just thoroughly enjoy this event and this ability to make money. And every day I get up and I thank God that we have this ability to make money because probably most parts of the world do not have this ability to make money. They don't have a stock market, or they're not able to get on and trade. As bad as things may be here in the U.S., we still have this ability to tap into the stock market and earn our daily bread, and that's exactly what I like to do, and I love to teach it. So I like to spread that news. I get a question every now and then. Well, they say, Hugh, if everybody does what you do, isn't that going to dilute your ability to make money on the market if everybody's doing the same thing? I say no, absolutely. In fact, it enhances it, because if everybody follows my system, my pattern, it makes it even better. It makes it much, much better. I just want to go back for a second here too. Talked about earlier on here, I mentioned something about predictability. That's another thing I want to mention about SPY. SPY is actually very, very predictable. I can look at a certain event that happens repeatedly, and I could say with a very high degree of accuracy that the market is going to perform in such a way based on history. And that predictability is so important because nobody knows where the stock is going to go. But when you have certain key things that unfold that way on a daily basis that we identify, your probability of success is much, much greater. And I love to hear back from the people, our clients, that, hey, I'm so glad you said that because I missed it. And if you didn't say that in your morning report, I would have missed it, and I not would have made my 10% that I did. I'm so excited and so happy. All right, so learning market behavior. And this is all part of it, okay? This is what we do. Learning market behavior. Folks, all indicators show history. Now, several years ago, I went back on TD Ameritrade Thinkorswim. That's the platform we use. One of two platforms I use. I counted something like 270 studies that were listed on the Thinkorswim platform, plus a bunch of drawings and stuff. I thought, wow, and I went through a lot of them, and I realized that a lot of them were the same, or they like none of them had any predictability in them. Okay, they were all showing history of some kind or other. And I discovered too why a lot of people are losing money with this, because they stack on all these indicators. I had one gentleman several years ago say to me, Hugh, I took your course, thank you very much, and it was working for a while, but it's not working now. This guy's name is Mike. He was in New Jersey. I said, well, it's still working for me, Mike. Why? What are you doing? So we went back and forth, and I finally said to him, Mike, I want you to tell me all the indicators, everything that you see on the screen, everything. So he would start listing all these indicators that they were not in my list. I said, Mike, what are you doing with the RSI? Where'd that come from? Well, my friend told me about that. All right, where'd this other one come from? Darvis boxes. Why would you put that up there? Well, my other friend told me about that. I said, okay, Mike, I now know why it's not working for you. I said to him, are you discovering that you're getting in on the end of a trend when it's no longer your friend? He said, yeah, that's exactly what's happening. I said, I know what's going on. You're waiting for all those indicators to line up, right? Line up, and then you get into the trade. Well, guess what? That trade's long over by that time. There's no way you can make money doing that. I said, I want you to strip away everything except those things that I taught you. Get back to those basics, throw them all in the East River, get back to basics, and see what happens. And you know what? That's exactly what he did. And guess what happened? He started making money again. Folks, all those indicators show history, but technicals, there is a combination of certain key indicators that we use in certain time frames that we use that can give us some pretty good clues to the future. Now, that's the technicals. Then there's also the fundamentals. This is the news and events that can foretell market sentiment in pretty predictive forms. Pretty predictive forms. I'll give you an example. All right, so House Speaker Nancy Pelosi says, I think I'm going to go to Taiwan. Well, China gets a little frazzled about this. I don't think so. Yeah, we're just going to ignore you. We're going to go, okay, well, China says, okay, we're going to do some military exercises. And, okay. So this creates tension, right? This is just an example of fundamentals. World tension now. The U.S. and China, here we go. So if we don't have enough on our plate, let's stir it up. So I knew in my heart of hearts that the market was going to, not be happy about this. And what happened yesterday? The market just collapsed. Now, before the end of the day, it reversed, went back up, and whatever, went up and came down, and kind of forgot. I think it went up and then it came down, but I knew it wasn't going to be, a well-received thing with the stock market. So these are events that happen, right? Interest rate increases oftentimes, it depends on the whole, all the events around it. But, inflation, all of these are fundamental aspects of the market that you cannot ignore. And to ignore that and just go with technicals, that's a big mistake, because news moves the markets. So we look at fundamentals, we look at technicals, and we combine these two to get an excellent record of determining market direction and strength, and that's really what we do. That gives us the advantage over those who don't know that. Now, you've probably heard that most people, various numbers out there, 90, 95, 98%, I heard all these numbers, options traders lose money. I'm sure you've heard that. I'm sure you've heard that 95% or so options expire worthless. I'm sure you've heard all of these numbers, but I can tell you that I make money. I make money on a regular basis, and a lot of the people that are with us make a lot of money. So the idea is to get on board with what we do, so you can be one of those 2 or 3 or 5 or 7% of the people that make money, and not those people that give the money to guys like us. Okay, learn the market behavior, and then you can actually, make money on it, right? Folks, it's time to assess in the morning. That's what we do. We assess fundamentals. What will most likely affect the markets today? Is it going to be inflation? How about earnings? We're in earnings season right now. That's going to have a profound effect on the markets, but you have to know what's going to be more important. High inflation, strong earnings, weak earnings, what's going to happen? Interest rate hikes, war in Ukraine, that's going to have an effect, right? Politics, elections, corporate news, economic news, all of this stuff is going to have an impact. And you have to determine, and that's what we teach, what is going to be the most impactful news of the day. And that is the direction we're going to fundamentally go to. Doesn't mean we're always going to trade in that direction, but that's going to be the flow, right? If the flow is to the upside, that's the direction we'd like to kind of go in. And then there are the technicals. How are charts shaping up at these various time frames? What happened to price in the last few days? Because usually we can tell what's going to happen by what happened in the last few days. Did we clear the path to a certain level? If so, then the likelihood of getting back to that level is probably pretty high. And then we drill down. We drill down from weekly, daily, hourly, right down to 1 minute charts. Where are the prices heading? Where's support and resistance? We look at all this. How much room is there for stocks to grow into? That's very important. That I don't know of anybody else who actually looks at that. They just look for a setup. Well, it's a good time to get in. But if you don't know where the stock is going to go until it hits the next resistance level or support level, you could be heading for disaster, right? In other words, with an option, if let's say there's only 4 or 5 cents to grow into, and then it hits that resistance level and comes back down, well, now you're sitting there holding the bag and wondering why, what happened, what went so wrong. Well, you missed that very key point. You want to see how chart patterns are setting up. How are they shaping up? And what about the Greeks? You wouldn't believe how many people I talk to say, I don't look at the Greeks. So I think, well, maybe you should. Okay, because with the Greeks, we can usually tell where the market, where exactly and when the market's going to go, and even how much you can expect to make. And it's actually uncanny. It is so uncanny. We have our own indicator called the yellow brick road, which extrapolates where our opinion is going to go with the market. And you wouldn't believe how accurate this thing is, and it just unfolds that way. And it's very comforting to know that the market can actually go that way, and it's actually pretty cool. Folks, these are all very, very important things that you do to determine market direction and strength. Then you have to see, well, which options do I trade? Which options hold the most potential? I have to check things like the delta, theta, volatility. These are the Greeks. What about volume? Where should I put my my money here? Are there other traders at the party? Sometimes people buy these options, and well, there's not a lot of activity at that level. Well, why do you want to go there? You ever go to a party and there's like, one other person? And now, well, here we are. Well, it's been a lot of fun. I'll see you tomorrow, How do you expect the market to perform? We check seasonals. We check for compliance with DayTradeSPY morning market analysis. Well, we don't check it. Our clients do, because when they follow that morning market analysis that you get in the inner circle, well, guess what? They generally make money. We are the ones that prepare that and send it out every morning at 9 o'clock. And anybody who looks at that, they say, oh, I didn't see that. I didn't see this. Oh my gosh, I'm so glad you told me about that. And guess what? If it's in compliance to that, generally speaking, you're going to do very, very well. Obviously, there's more to it than that. Folks, so you got to get that. You got to leveraging a solid strategy. This is where it's really important. Okay, so now you've got the quality stock. You've now figured out something here about the way the markets work, and you've learned a little bit here. This is all we teach, all this stuff. There's nothing you have to go anywhere else. You figured out things like chart patterns and support resistance, and you've got fundamentals in place, and you've got all these ingredients, right? You've got all these ingredients. I'm pretty sure that in my kitchen, I probably have enough ingredients to bake a cake, but I can assure you, as sure as I'm sitting here with my culinary skills, which I can write on the head of a pen, still have room left over, that cake's not going to come out very well. So I need a recipe. I need to know, what do I put where, how much, how do I mix it? Do I have to wait? Do I have to, add anything else? Do I put it in the oven? How do I put it in the oven? Do I have to let it heat up first? And, there's a million things I got to learn. Probably because that's why I never became good at any of that. But I don't have the patience. You can probably tell that by the way I speak. I speak very fast. But anyway, you have to find a solid strategy. And that's another thing we do. We actually have strategies. In fact, we have some really cool strategies that we have developed over the years, as this young lady will present to us. We actually have 3 great strategies, basically all coming out of the same essence, which I consider my bread and butter strategy. Now, this is a strategy that invokes some key indicators that if you were to be a beginner, let's say, this is probably your less risky trade. Okay, I don't want to say safe. I don't want to allude that there's any safety. There's no safety in options trading at all. But I would say the bread and butter strategy is less stressful, and it's pretty consistent with its gains. Now, you may not make $1 million in a week or something like that, but it's kind of a really nice, good, solid basis with which to learn our strategy. And then our next up is our out of the morning gate, which is highly reliable. Again, usually early profits on. And this uses some very key indicators that we use. And this is actually ideal for those people who may not be able to watch markets all day or charts. Maybe they're working, but they do have that few minutes at the beginning at about 9:30 in the morning Eastern time to get in and assess market conditions and make a decision as to what they want to do, what they want to buy. So it's actually kind of almost anchored. It's not anchored in time. We actually have this other one called the pick of the day, which is actually anchored in time. But this does use a key setup that usually presents itself within the first few minutes. So out of the morning gate, OMG for short, little play on words these days. And it's actually it's really cool. This morning we made some money. We have a target of 6% on this. And every day it seems like it just hits that target within the first few minutes. That's the second strategy. The third one is scalping, my favorite, my all-time favorite, and this is actually pretty cool. So you're going for smaller gains, more frequency. These are quick and they're exciting. And this is the one I prefer. This is one I do a lot, and I walk away with some pretty good money every day, and like really good money every day. And I absolutely love it. I live for scalping in the financial world. Okay, obviously other things are more important to me than this, family and all that stuff. But when it comes to a career, I zero right into this scalping, and this is what I love to do, and this is what I do. But again, these are still all based off the bread and butter setups. Okay, so this is what I do. Now, I actually have some tips for you because we're actually in a pretty volatile market. So I thought I'd give you this here as a bit of a bonus for being on this webinar. So nobody else really has this except those people who are in our morning training sessions. But I thought I'd give these to you so that you actually have this. And if you want to write these down and go back and review them later, I think you'll get a real advantage to this. These are very important points to stay on the right heading in volatile times, because you all know that when markets are volatile, you can lose your money just as quickly as making it. And so these are really good tips. These are tips that I use all the time for myself. And I still go back and I always kind of review these just to make sure they are very ingrained in me, in myself. Okay. Number one, always buy time, no matter what. If you expect to be out of the trade in 2 minutes, doesn't matter. I still buy time. Reduces stress when you know can let the market forces vacillate the stock and the price is naturally going to come to you. You also have time to repair it. By buying time, I'm talking about I buy at least 4 days, usually a week, week and a half. Yes, options are going to be more expensive, but if you only have, say, $3,000 to invest, so you just buy fewer contracts, no big deal, right? So always buy time. Time is your insurance in this business, okay? Time is your insurance. There's nothing worse than having data loss, which is time, eat away at your options like a cancer when you don't have a lot of time. And any options that are going to expire soon, that's exactly what's going to happen. There's no advantage to buying something that's going to expire soon if you're going the wrong way. Believe me, you're gonna end up losing. If not today, then tomorrow or the next day. Number two, keep your reserve well funded. By this I mean that if I have $20,000 to invest, as an example, I have more, but if I had just that, I would only invest about $2,000 to $3,000 of it, holding back the rest to fix a position if and when necessary to reduce my cost base. But there's another reason too. From a mental standpoint, you don't want to put all your eggs in one basket, so to speak. What you want to do is always make sure that you have that cushion in there so that should you need to fix a trade, you can. And you're not going to be as stressed out knowing that this trade has to work or else I lose my rent, I lose my mortgage, I lose, whatever. Number 3, pay attention to the setups. Those setups that we tell you, you really got to focus on those. Nowhere it's more important than in volatile markets where sensitivity to news is the highest, especially true in the summer, both going up and down. Never be hasty or neglectful. Number 4, only trade calls during earnings season. I found, unless you're really experienced and you're okay with puts, but I found that the general forces markets like to gravitate to the upside and in these weeks, so there's no sense in paddling against the natural flow of the market. And like I said, unless you're really experienced and you know exactly what you're doing, you know the risks. But if you're not familiar with it, just trade calls during earnings season, all right? Calls generally go, markets generally go to the upside, so call options is the way to go on that one. Number 5, pull the trigger. All right, it's unbelievable how so many people would say, well, yeah, I was looking at it and I just couldn't pull the trigger. I couldn't pull the trigger. I couldn't make it happen. Folks, be aggressive when necessary. You have to make a decision and go through with it. The market's not going to wait for you. And then when it's time, get in there, get your buy field, immediately put it up for sale, stay humble with your exits, and reap the benefits as that happens. Now, on the other side, you do have to exercise patience. This is always key. Always keep it more important in volatile markets because prices can and do massively turn on you. Sometimes you just got to stay calm and let that economic storm pass, which it will. Number 6, watch your FOMO, fear of missing out. There's always going to be another trade right around the corner should you miss this one. Yes, you are going to miss trades. Don't worry about it. High volatility is like shooting fish in a barrel. You're going to make money, all right? I shouldn't be so definitive about that. You should make money. If you know what you're doing, you should make money. Number 7 here, watch your greed. Greed is the number 1 because when you're sitting there making a lot of money, you tend to get greedier and greedier, and that's usually what's going to end up biting you, your greed, all right? Prices can turn on you quickly and leave you just hanging so fast you didn't even know what happened to you, all right? Know your exit prices, stay the course, wait for the next setup. Very, very important. I'm going to give an example of what I did. These are real trades that I did here today in front of a live audience. We have been trading in front of a live audience since 2010. And these are real trades that I filmed. Now, this is using Tastyworks. And those of you who are familiar with Tastyworks know that they do not have a sim account. So these are actually real trades. I'm going to quickly go over these with you. Trade number 1, this actually goes from the bottom up. The way it works is right there. They're all SPY, they're all filled. Those numbers you see, the price, that's the price it was filled at. There are the times right there, right to the second. August the 12th, that is the expiration date. You notice that I went a week and a half out Friday, right? And it tells you 9 days. And then there's the strike price, 411s, 412s, C for calls, P for puts, they're all C's. BTO is buy to open, STC over there on the right, sell to close. Trade number 1, 441 calls. I picked up 17 cents in 1 minute, 49 seconds. 1 minute, 49 seconds. This was in live trading room. Every time we hit a score like that, we hit the bell. Trade number 2, you can see it, 931 to 933, and then 935 to 936. That was actually in 26 seconds. I picked up another 16 cents in actually 1 minute, 26 seconds, I should say. There's another bell. Oh, that was a sick bell, wasn't it? How about that? There you go. I love the bell, folks. I was wondering the bell. Trade number 3, the 411 calls once again, in and out, in and out, in and out. 551 to 565, that's 14 cents and 53 seconds. Trade number 4, this all happened before a live audience, so people were watching this unfold. Then I jumped on the 412 calls, 527 to 555, that's 28 cents in 8 minutes. And trade number 5, I did the 412 calls again, 569 to 575, 6 cents in 1 hour, 25 minutes. Now, those who are astute will recognize that the ones I did later, it took a little longer to execute, which is actually kind of a nice tip for you, right? So if you want to make money, get in the early part of the day. Now, some people are going to say, oh, that's amateur hour. Hey, guess what? I make a fortune in amateur hour. I don't care. Call it what you want. I don't care. Amateur hour. What's that? Who cares? You know, this is the term I used to hear all the time. I don't follow anybody anymore. They follow me. But I got to tell you, I make a lot of money in those times. And I find that sometimes later in the day, that's when I make less money, or it's harder to make the money. So I was happy with 6 cents. But here's the key. This is what I'm going to show you. Now, I did not put on here how many contracts I traded because I did not want that to intimidate anybody. People say, well, you're trading so much money, you're out of my league, or, oh, wait a second, I'm trading $100,000 and you're only trading, $50,000 or something. Why am I taking instructions from you? So I eliminated how much money, but trust me when I say I had a lot of money in these trades, okay? But folks, most of you perhaps are going to trade maybe 10 contracts. In this scenario that I'm showing you right here, if you traded 10 contracts at each of these trades, you'd have made $810 less commissions. With Tastyworks, it's $1 a contract to get in, $0 to get out, plus a few cents with exchange fees. $810, and that would be per day. If you do that per day, 252 trading days a year, that works out to over $204,000 a year. Let's say you did only half that, you're still walking away with over $100,000 a year. How's that grab you, folks? And guess what? Each of these trades, I had absolutely no more than $5,690 invested at any one time, and I was done before noon. We do this every day. We do this every day. Real money, real trades. Real money, real trades. All right, I am going to move along here now. I'm showing you this to show you this is not pie in the sky. This is very possible, probable. People are doing it. And by the way, I'm hardly the best at this. I have people in our trading room that blow me out of the water. I'm so proud of them. If it wasn't for privacy laws, I'd be parading them in front of everybody. I have people that are doing extremely well, much better than me. This is just me, a normal average guy, and anybody, there's no reason everybody should not be doing this kind of money. Folks, are you ready to make some money this week? Please put in the chat box, in the questions box. I'm not so sure I can actually see that, Sherry, but I'm going to guess that people are going to say yes, they are ready for this. If they are not, then I'm going to thank you for just being here, and I won't waste any of your time. I'm going to guess that there are some people that are going to say yes to this. If you are ready to make some money this week, then I'll tell you something. This is where you need to be to get started. You got to get started somewhere. I'm giving you a really cool way to get started. First, I want to ask you to join the Inner Circle. The Inner Circle. Now, this is a really cool place to start. We give you a pre-market analysis every morning. Every morning at about 9 o'clock Eastern time, we give you a pre-market analysis, all right? We sift through the news, events, all the market forces that are going to give you an idea as to where those fundamentals are going to be and the technicals. And then we're going to find out what the experienced traders want to trade. In other words, myself and Alex and some of the group that we have, what we're looking at. We're going to be using technical analysis to include support resistance lines and other key indicators. So we're going to tell you things like, well, I want to get in here, or if this happens, then I'm going to get in this way or that way. And these are also going to provide you with live weekly training sessions. Weekly training sessions every week. We get together Tuesday night at 9 o'clock Eastern. All right, we review the day's events, showing you how the trades, how they play out, what we actually did. Interactive webinars for your chance to learn. Bring your questions, we answer them, and it opens the communications lines with us. So as an Inner Circle member, you can simply email us with any quick questions during the week. And it's kind of like having a personal mentor, only an email away for the price of a Starbucks coffee. Folks, flash assessment of how the trading day may unfold. This is the Inner Circle. I'm going to tell you right now, if this doesn't, light the fire under your butt, I don't know what does, because the cost of this is only $79 a month. Only a $79 a month payment for this amazing information. And this is where you need to be, the Inner Circle. Again, you're going to get the morning market assessment emailed to you at 9 o'clock in the morning. You're going to get a follow-up report later in the day as to what we actually did. You are going to be invited to our weekly meetups every Tuesday night, 9 o'clock Eastern time. By the way, these are recorded and sent to you, so you don't actually even have to be there. But if you have any questions or whatever, you can bring them to these Tuesday night sessions. We will answer them for you right there. You're also going to get some early notices of specials and events, right? And of course, you get email support for only $79 a month. And this guy's pretty excited about that, as so should you be. Now, I also have a special bonus. All you have to do is mention Traders Exclusive. All right, mention Traders Exclusive for Hugh's top 25 tips, tricks, and traps. Top 25 tricks, tricks, and traps. Hard to say. I kind of did that on purpose. Top 25 tips, tricks, and traps. Say that 10 times and see where you come up with. So, folks, I think this is a real special deal. And what you're going to do is this. You can actually, all right, get this right now. If you go to this website, you don't have to put www in here. Just punch in getstarted.daytradespy.com. Getstarted.daytradespy.com. Or you can simply go to our website, daytradespy.com, and hit the contact us button. Send us an email. Get in there and let us know, and we will send you the link. Again, $79 a month. Subscribe today. It's really easy. You don't have to even be on PayPal or anything. You can just with your credit card, just get right in there. And at this point too, I want to thank you all for joining us. I want to thank Sherry and everybody at Traders Exclusive for providing this wonderful opportunity to present to you this afternoon. And folks, remember, if you want what I have, you got to do what I do. And my name is Hugh. Thank you again, and thank you, Sherry.
Thank you so much, Hugh. That was awesome. You guys, I put the link. It's not actually showing as a link. Just a minute. Getstarted.daytradespy.com. So there it is in your chat. You'll be able to just click on that to go and check that out. And Hugh, thank you so much for being with us. I do hope you won't wait a whole 2 years to be back with us again.
We'll see you sooner than that. Thank you so much. I appreciate it.
Thank you. You have a wonderful day.
Thanks, you too.
Bye-bye now.
Bye.
All right, let's see. I want to move something around here. I know that our next speaker is waiting to come in. I just need to do a little bit of housekeeping. Let's do this. And our next, I wanted to just remind you, if you do have to leave today, the replay of this webinar will be at tradersexclusive.com/archived_webinars. And that's also where we post a lot of articles and videos that they're just chock full of good information and great things to help you improve your trading. We also have a free ebook there. But the next person up now is Price Headley of BigTrends. And I want to just let you know that he's going to talk to us about how $1 options have quadrupled in 2022. Price Headley is the founder of BigTrends.com, which provides investors with specific real-time stock and options strategies and investment education to profit from significant market trends. Price has appeared on CNBC, Fox News, CNN-FN, Bloomberg Television, and a variety of print and online financial news outlets, including the Wall Street Journal, Barron's, Forbes, Investors Business Daily, USA Today, and Bloomberg Personal. Timer Digest recognized the success of BigTrends.com's investment strategies by ranking Price among the top 10 market timers for stock market timing. That's impressive. Price, thanks for being with us today. Let me see if I can.
Hi, Sherry. Making sure you can hear me okay.
Yes, I can hear you. I'm going to make you the presenter. Thanks so much for joining us. It's been a little while.
Pleasure. Just a pleasure. Always fun to be with you here at Traders Exclusive. I want to make sure you've got me set up as a presenter or whatnot so I can share my screen. There it goes. So I can share my screen. Let's make sure.
Now, do you like to have questions answered on the fly, or do you like to hold questions until the end?
Let's hold them to the end, and then I'll see what we can pick up. I'll try to leave a couple minutes after the 45 minutes is up.
Okay.
All right. Thank you, Sherry.
Take it away.
Appreciate it. And good afternoon, everybody. I know you've already been hearing some great trading content. I'm going to seek to keep that trend going and focus you on a little different approach, which is kind of the big trends philosophy, which is not scalping in and out over a period of seconds or minutes, but looking for the bigger moves and how you can use these cheaper $1 options to as much as quadruple your potential investment. We've had a number of those already in 2022. These are options that you can control big name stocks for a lot less capital. And that's really one of the original attractions of options, is the leverage potential that they offer. As we all know, 2022 for a lot of folks has been a challenging year. For us, it's been kind of a gold mine, I have to say, in our Grand Slam service, which focuses on these cheaper options. There's going to be winners, there's going to be losers, but you take advantage of the bigger potential upside while managing your risk. Now, as we get started, just a reminder, everything we talk about here today is based on our proprietary research and is intended for illustrative purposes only. These should not be considered to be specific advisory recommendations today. Stock and options trading, as you know, have large potential rewards, but also large potential risk. The past performance of any trading system or method is not necessarily indicative of future results. Do see our terms of use on the BigTrends.com homepage for more information. With that behind us, we're going to focus on these options that are quoted at $1 or less per contract. Remember, one option contract controls 100 shares of stock. So you actually have to multiply it times 100 for what you're going to invest to own one contract. If it's quoted at $1, that means times 100. It's $100 to control 100 shares of stock. When you look at Apple or whatnot, Apple trading now in the 160 plus range, 100 shares would cost you 16 grand. You can control that Apple stock for $100 or less with what I'm going to teach you about today. I think that's even more important as a risk management tool for you. If you're worried about the market, we talk to a lot of people that are, the fear is out there, right? There's a lot of people worried about inflation, the Fed, the economy, our president, our government, the Ukraine situation. There's so many wall of worry reasons, and yet you notice recently the market's rallying. And so you want to make sure you're positioned to take advantage of that and not getting stuck in what you hear. But we trade what we see, what the charts tell us. And we use several indicators with our Grand Slam options program. One of them is called the CCI, the Commodity Channel Index. I use it for big name stocks too, and options on those stocks. BigTrends Bands is a tool I developed to show me when we're moving out of the range and into a more strong trending phase. And then ADX, as well as Wilder's average directional movement indicator, that's a trend indicator as well. I don't look at just one of these trend indicators. I look at all three together. All three have to be signaling for me to get a BigTrends Grand Slam options opportunity. So we're going to review a number of trades and success stories, and also give you a summer spectacular super special that you want to hang around for, that I think is going to be well worth your time invested today. I founded BigTrends back in 1999, so we're coming up on our 23rd anniversary actually in November. And I told people in 99, this is not a day trading as a means of success type of an approach. And that's when everybody was touting day trading. And we're getting a little bit more of that in more recent times. I've always believed that you want to ride a trend for as long as it's in existence. And a lot of the trends I'm going to show you can last for not just days, but even weeks. But most of these moves for us are happening in about a 5-day window, give or take. So kind of a classic kind of swing trading time frame. I started trading 32 plus years ago. Actually got the trading bug when I was at Duke University. And after graduating there, basically was able to become an options analyst for the nation's largest options newsletter, and then start my own company at the end of the 90s. So our whole goal at BigTrends is time-tested research. There's data behind what I'm sharing with you. It's not just my opinion or just some best case picked out some examples with, the reality is we're going to talk about losing trades as well as winners. But let's get into some examples and talk about, we typically target for up to a quadruple, which is a 300% return. Now, this one I'm going to show you on LI Auto, ticker symbol LI, kind of capturing this whole electric vehicle wave that, of course, Tesla has driven a lot of that, and now we're seeing a lot more competitors popping out. This one ended up getting even a little past our target. So in these charts that I'm going to show you, these are TradeStation charts. You don't have to have any set software. As long as you've got a working email and a working text alert on your smartphone, which most everybody has, you can get the information one or preferably both ways, sent to you real time whenever we get a new signal. And this was a breakout in LI Auto, and you can see on this chart we've got a couple different indicators happening. On the middle panel, this is the Larry Williams percent range or percent R indicator. And I actually left it red. Red's supposed to be bad, right? Like a stoplight, red is stop. Don't keep going, stop. Otherwise you might get in an accident. We don't want that. Well, actually the irony is, when you look at these overbought signals that stay overbought, they actually are exactly what you want to trade. The overbought market is not a bad thing. It can be powerfully good. The blue line down here is the CCI, the Commodity Channel Index. Okay, so CCI was developed back at the start of the 80s. And to me, it shows me more of what I call the thrust power of that move. So when I see a breakout above this upper 100% threshold here, I want to say what happens on both of those above this high. The first high of that first half hour bar was back on June 14th. We did close above it a couple of candles later, about an hour later on a 30-minute chart. So 2 bars later is an hour. And so you say, okay, look, an hour later is closing above that first high. What does that tell me? It tells me the institutions are adding this name. They're not just kind of bailing off of a gap up, and it's not just selling right back down. They're actually saying, we want more of this. And let's face it, the institutions are the ones who drive the market, not you and me as individual traders. So the reality is, we want to focus ourselves on how we zero in on this and make sure that we know, okay, you see, at first we get in here and look what we were buying. Look where the stock's trading. Stock's trading in the neighborhood of about $32 a share, right? So we're buying a 37 strike call out to the third Friday in July, which is right about 30 days away from the expiration on ticker LI. So when you buy a call, if you're new to options, this means you've got a right to buy the stock at a set price of 37. You say, hold on, it's at 32. Why would I want that right 5 points higher? Wouldn't I want the 32 call where we are right now? No, you'd pay a lot more for that option if that's an at the money option at 32 where the stock is. The out of the money options are going to be more aggressive, but they're going to be the ones that can give you great bang for your buck, great ability to not just double, but even triple and quadruple when we get these trends right. And then if it doesn't work, we cut and run, limit our loss, and we don't get stuck in it. We move on to the next opportunity. So the idea here, though, is that we bought it for $1. That means $100 a contract. A lot of our subscribers will trade typically a 10 contracts getting started. So that'd be $1,000 invested, $100 a contract times 10, $1,000 invested. If you can double your money on any given trade, I don't care if it's this system or any system, I'm a big believer in selling half at the 100% double target. You can see that after chopping around for a couple of days, it even went through what we call a classic retest scenario right here where it had to hold that low on future closes, and it did. And then it took off a couple days after that, and we're cashing it in a week later on the 21st on that gap up. It's now moved up to as high as 36. It still hasn't gotten to the 37 strike at price, and that at the same time, that dollar that it was worth is now worth $2 or $200 a contract. You've doubled your money on about a maybe, what is that, about a 13% move in the stock. It's gone from 32 to 36, right? So the idea here is that, look, okay, we're getting a nice leverage. It's not massive leverage, but it's good enough for me and for our Grand Slam subscribers. They tend to be really pleased with this approach. Why do I sell half at a double? Because if I can get my risk capital and your risk capital back in your pocket, then you can basically keep the rest of your position on and give it a chance to go to the 200 and 300% target profit objectives. So in this case, if you had 10 contracts, you'd sell 5 of them out. Remember, 10 times 1 is $1,000. Now you're going to essentially 5 of those times 2. That's your $1,000, $200 a piece. They're worth 5 of those contracts peeled off. You put your $1,000 risk capital back in your pocket. You still have 5 contracts worth another $200 a piece. So you still have another $1,000 in the trade. And what we say is that at that point, if it goes on and goes up to the 200% profit, take half of your remaining position off the table. If you're more conservative on an odd number like 5, you would take 3 of the 5 off at 200% and target 300% on the final piece. And so you say, okay, look, now you sell out 3 of them. Now you're up to $3. So essentially, the next time you peel off 3 contracts, $300 a piece, they've tripled. That's another $900, and that's your profit money that essentially you're now starting to ring the register on profits. You made $900 with 2 contracts left. That you see, we did get to the final target here. 310% was made right here as we cashed out just under $40. Okay, so now the stock's gone up from the 37 strike at $40 is worth 3. We're actually cashing out at 4 because it still has some time premium in that option. This move only took 6 trading days to develop. So the key principle here that I want you to be aware of and watch as I go through the rest of these examples and concepts here is that we look at the situation here in which you want to be able to ring the register gradually and know that overbought is not a bad thing. we're not trying to call exact lows and exact highs. We're trying to take the meat out of the middle of the move, the sweet spot, I call it. And that's where you see it even went a little higher afterwards, but then it came cratering back down not long after this chart ended. So the idea is that, look, you book profits gradually as the market move is working for you. You don't try to make pennies, picking up pennies in front of the proverbial bulldozer. You ride the bulldozer for the bigger move, the bigger trend, the bigger opportunity. So you can see in this case, you're going to average just over a triple on your whole investment. So your $1,000 is turning into a little over $3,000. You made a couple grand in profit off of $1,000 in just 6 trading days. Now, that's an extraordinary example. Not everyone is going to do that, but the 300% winners can actually happen more often than you would expect, and sometimes incredibly fast. This name here that we traded this year, Range Resources, ticker RRC, was super fast. This one was interesting because you see we're picking it up as it just starts a breakout the morning of May 25th. You see my CCI, we're going to get into ADX here in a minute too, but both of these indicators, CCI and percent R, CCI on the bottom, percent R in the middle panel there, are telling me that that's a setup at that first bar's high. And you see we barely closed above it on this very next bar where we circled that oval there on the top in black. So at that point, Range Resources is trading about $31 a share, you can see. So $31 a share, you say, okay, what are you buying? We're buying about 10% out of the money. We're buying the third Friday of June expiration, the 34 strike calls. These options have just under a month to go before they expire, about, call it maybe 3.5 weeks. And you say, look, we know that typically we're going to be in and out of these in a week or less in most cases. We paid 85 cents or $85 a contract. So again, if you're buying $1,000 worth, that would get you in the neighborhood of about 11 contracts for invested a total of about $935. You can't get a 12th contractor that pushes you over your maximum allocation. One of the other rules of thumb that you'll note is that you don't want to get greedy and say, I think this is a better one than normal. I'm going to buy more on this one. Or I don't like this one. I'm going to sit this one out. We're all about being consistent in execution. As long as you're consistent in execution, you can let the system determine your success, not you trying to, quote, add value to it by thinking you know better. Most people that get started with this method, they make the classic mistake of thinking that's overbought. Overbought's, everybody's been trained as bad. And so you look at a situation where you say that's an overbought is not bad if it keeps going up. It means the institutions want on this one. So you can see we paid $85 a contract. Remember, a June 34 call, you say, well, what happens if it goes on up here to 33, 34, 35? That's where we were ringing the register on all of our targets here, literally about 24 hours later here, the next day on the 26th. You say, look, we're ringing the register from 33 to about 35. The stock is barely gone in the money above 34, maybe a point in the money, and we're cashing out from $85 a contract. Our first target, we sold half at a double, which would then be what, $170 a contract. Sold half our position. Then we go on up and we're sending out email alerts to our subscribers, so you would get all of our updates like raise your stop to this level. Target is now moved up from $1.70 to the next target, which is $2.55 on the triple, and then the final target, of course, is $3.40. So 340, you would think, well, a 34 call, that means it's got to get above 37, right? It doesn't, because you can see we've got time value still in this trade. So you can see we're ringing the register. It ends up coming down not long after we sell out. So the idea is that, look, you were guiding it through every step of the way, whether it's a win, lose, or draw situation, and knowing that it's all about kind of just having a plan of gradually taking money as the market makes it available to us. I find by selling half at a double, my clients are so much more relaxed about then giving the trade a chance to keep going to its bigger targets. Too many people have had too much scar tissue from your past trading mistakes, where you say, okay, well, I've let profits slip away in the past, so if I get a 20 or 30% gain, I just go ahead and cash it out because I don't want that to turn into a loser. That's a loser's mentality of trading, especially if you're looking for the bigger home run grand slam opportunities. You've got to be willing to let the profits run on good trades while still having a plan on getting out of bad trades in reasonably short order, which we'll talk about too. So this was Norwegian Cruise Lines. As you know, the cruise line stocks have been pretty volatile. They've come back down since we cashed out of this one in late March, early April. But you can see in this case, we were buying a third Friday of April, April 21 strike call. Stock was trading about 19, if I recall. We lost our scale on the right here, but we're a couple points out of the money, maybe 10% out of the money. We're just seeing the breakout happening here, and we're saying we want to be on these April 21 calls. We paid 74 bucks a contract. So again, if you bought 10 of those, that'd be 740 bucks. If we're buying, in the neighborhood of $1,000 worth, that could get you about another maybe 3 contracts. You'd be in for about 13 contracts for just under $1,000 invested. So you look at this and you say, okay, we got our first target. You can see as it keeps on staying overbought. You notice the pattern on these indicators like CCI, the blue line, how it stays above that 100% threshold. That this is a retest. This retest has to hold. It does hold right off of that low right there, and then it takes off for our final target. We actually got really close to our 300% profit, and then it flipped on us, and we had to hop out later that day after getting 102 and 204%. Our final third of the position, if you will, last piece, I should say, would be at exit just about a double, 98.6% gain. That one gave back some from its peak. That's why you take partial profits. If it keeps going after getting half out of the double, you're happy you still have half on. If it does reverse back down, say it even reverses back down to a break even on the second half after you had a double, you still average 50% for the trade, selling those two halves at 100 and then at 0. So the idea is that, look, we want to really focus on, being sensible, not being greedy. It's kind of ironic, right? I use one of the more volatile vehicles out there in options, especially out of the money options, but then I use strategies to harness that volatility. It's kind of like, how the original Tesla or Edison inventors were harnessing the power of electricity. That's what we're doing here. We're harnessing the power of trends and the power of options to truly create a breakthrough that most people, frankly, can't see because they've been trained wrong about overbought being bad, when you can see it's actually can be powerfully good. So if there's something I want you to take home from my presentation today, outside of the great offer I got for you at the end, it's that don't look an overbought horse in the mouth and think, I don't want this one. Start to actually get on the horses that are the speedboats, the fastest out of the gate, that actually have the potential to win wire to wire, using the horse analogy. If the institutions are pouring the money on, you want to be a part of that. So those are call trades, bullish examples. What about bearish put examples when the market drops? Sure, we can do that. We do it all the time. Throughout the course of a year, with plenty of opportunities on both sides of the market. This was a bear opportunity in Zillow, ticker symbol Z, which of course is an online home listing site, and they even had been getting into the flipping game, which, as you know, not going so well with interest rates doubling in 2022 on a 30-year mortgage. Unbelievable move in interest rates, and of course that's been painful for the housing sector as well. So you look at this and you say, okay, so when we were getting our signal that Zillow's breaking down back April 20th, that you say, look, we were buying out there the third Friday of May, the 35 strike puts. Now these were pretty well out of the money. The stock's about 45. We got our bear signal in here as it broke down right there on the left side of the chart. We're saying, look, this is confirmed on both the indicators. We'll get into ADX as well, confirming. We just didn't have room for it on these charts to teach you about this. But what I love about this example is you see that at first we're right. We don't get our double in the first day or two of that trade. Then it kind of retraces back against us a little bit. We use both intraday and daily charts to kind of confirm both the short-term and broader trends, which were down on Zillow in a big way on the bigger picture. And then when it gapped down this next day here, about the fourth day in the trade, we're bringing the register. Stock's about 42 bucks here. So it's gone from about 45 to 42. It hasn't even dropped 10%, and we're making 100% on that 35 strike put. Remember, you've got a right to sell the stock at 35. You say it's at 42. Why would anybody pay $1.80 for it? We paid 90 bucks on the way in, 180 cashing out a half. But this is the reason we sell half of the double right here, is that if it doesn't keep firing, at first it was dropping, we got close to our 200% profit. We got kind of a nasty reversal at the start of May where it came back up pretty sharply, and our trailing stops got tagged, even got a little bit worse fill than what I thought we'd get, and we only made 16% on the second half. And you say, oh man, you're at a double and now you're only making 16% on the rest. But you add those two halves up, 100 plus 16 divided by 2, that's a 58% win in 8 trading days. Would you take 58% in 8 days or a couple of weeks? This is just under 2 trading weeks. Yeah, there's nothing wrong with that. That's healthy. It's not a home run, but it's steady. And the more important point is that we've got a risk management plan that's giving back too much profit. We're not going to ride this thing out to a minus 100 unless it has just some crazy wicked gap against us. And that's why I typically will be out of these situations in front of earnings, unless we've gotten a double on half. We're not going to roll the bones on earnings and just hope earnings bails us out. If we get a double and half, you have a free trade, we can take a shot with earnings at that point. But a lot of times, if it's giving back too much of our profit, we're just saying, let's protect it, still turn that. We don't want to turn a good trade into a bad or break-even trade. We want to still make some money regardless. As we showed you with Norwegian Cruise, we hit 100 and 200% before it tagged its trailing stop. Here's another example of that happening. This was U.S. steel calls. You know that the economy is weakening, right? But the bottom line is that this is right after Putin invaded Ukraine, Russia come into Ukraine, and U.S. Steel actually initially popped down on that news like the rest of the market did. But look at, this is the day that it came back, okay? Now, that turned out that our setup on both CCI and the blue line and %R didn't even happen until the next day, and then that high has to get taken out, and it closed above that high the day after that. So even as we get into the start of the next week, we're in there buying on that Tuesday morning after the Russia invasion of Ukraine, and everybody's wringing their hands saying World War III is coming and yada, yada, yada. And, you know, obviously, you know, it's still a serious situation over there. I'm not diminishing that. But what I'm saying is, if you get stuck in a fear mode because of the media, because of what you're seeing, because of a market gap down, that it did happen in the market, you will miss the leaders that come out of that. As you know, we had tons of shortages, whether it was wheat and grains, in this case, steel. All these shortages, of course, were causing big price hikes, and that was meaning good news for U.S. Steel stock and the company. And you say, okay, so we're getting into U.S. Steel. Stock's a little bit below 29 strike. We bought the March 29 calls. Now, this trade, we told our subscribers, we've got about 4 days for this trade to work, because if it gets to the first Friday of that expiration month, we will be out of that trade. So right now, for example, if I have any August trades on, which I do have a couple on, those will be out by this Friday, because we don't hold them with 2 weeks or less to go before the expiration. It's just too much time risk. So I said, we've got 4 days for this trade to work. Look what happens over the next 3 days. We're cashing in for 100, 200, and then we don't quite get our 300%, and our trailing stop gets tagged at 125%. All that happening in 3 days. It turned out that next Monday it did spike up. It would have hit a 300% win. I don't play the woulda, coulda, shoulda game. We take the bird in the hand. We don't go for the two in the bush. It's all about being sensible with your trading approach, not getting greedy, having a plan to gradually take money out of the markets. Apple is one we love to trade. You know, here's Apple with a daily chart from the past where it was breaking out on the upside. We've been big fans of Apple. You can see that, you know, it's like, hey, the market keeps rewarding it. You want to be a part of that only for options, only when it's starting to get this heat up happening. This is a daily chart now. And now we've lined up not just %R and CCI on the top panels, but this green line down below is called the ADX. It's the average directional movement. ADX basically tells you, is it trending or not? And ADX going up, the green line going up off a relatively low level. In this case, we're the blue net new highs line, what's called the DMI plus. That means, are we making new highs? You can see them on the chart, right? We're making new highs. Are we making any new lows? On the look back, not really. That's the negative red line there. When those lines start to pull apart from each other, ADX starts turning up. That tells you you're actually at the start of a trend move, not at the end. So if you're worried about, oh, it's moved too much, I've missed it, I missed out. How many times do you think you missed out? You look back and you say, wow, there's a lot more meat on the bone. My fear took hold of me. This is what ADX does for us, is it says it's just starting to cross up. This tells us we want to get on this breakout. We're not too late here, right into this move right here on the 17th. That was last November 17th. And even of just the next, you know, basically a total of 3 trading days from that one morning to a couple days later, about 3 full days, we made 100 and 200%. And then the last piece was triggered out at 146%. So we won't always get that 300% final target, but it's okay. We're taking a lot of nice profits over just a few trading days. Notice we bought the 165 calls with about a month out into that third Friday, December. We got on in mid-November, and we were out in just a few trading days. So we buy more time than we need. That's to be more sensible about not taking on too much risk. AMD, you know, just had earnings yesterday, reacting with a little down gap this morning, but coming back up a little bit with the markets today. But this is a we're not in AMD right now. This is a past example where AMD was just starting to break out on all three of the indicators. We hopped on and bought, when the stock's trading about 113, we bought about 20% out of the money. We bought the November 135 calls in mid-October. Third Friday in November is the expiration on these monthly options. So we're, most cases, going out about a month, give or take. And then you look at this and say, okay, yes, we're buying way out of the money, but look what we're paying. We're only paying 72 cents. It's 72 bucks a contract. If you bought 100 shares, it would cost you over 11 grand. So you say, okay, look, I can control $11,000 worth of stock for less than 100 bucks. That's like a 100-to-1 leverage ratio. So as it grinds up over the next 4 days, we get 101% profits. And look what the stock's done. It's only gone up here from about that 112 area to maybe at best 120. It's gone up maybe about 7%, and we're up 101%. So it's not 100-to-1 leverage, obviously, in that example, but it's saying, look, you're still getting like a 14-to-1 leverage, 15-to-1 leverage-ish, and you're saying, okay, and now you've got a free trade. And I think this one came back closer to break even, and maybe we averaged closer to 50% on the whole position. So it looked good on this chart, right? But that's why we sell half, because even if it comes back and hits our trailing stop, we're going to take it off and move on. Not every trade is going to win. Here's an example of one that did not take off as quickly as the others. This was Marvel Tech, MRVL. Really liked this one, kind of checked all the boxes. When the stock's trading about 75, our short-term system, it's a daily chart, but our intraday system, kind of to confirm it, said buy it right here. This was back also last November. And you can see that this example says, look, we're buying about 10% out of the money, buying the 82.5 strike calls, 7.5 points higher than 75 bucks where the stock was. We paid 90 bucks a contract. And then it just flatlined on me, and it went through what I call a retest. The percent R was testing back under its overbought threshold right here. That doesn't mean I get out. It means I watch that support. That support's holding for the next week. But once it violated right here, 8 days into the trade, we blew it out. We were down 23 1/3%. They had earnings coming up in a few days. Turned out the earnings would have bailed us out in this case, because it went from, you can see, low 70s to mid 80s. But that's not the game we play. I'm not afraid to admit that, okay, we got out of that one. It would have, in retrospect, worked out. We followed our system and our plan of risk management. You don't want to ride something out to a wipeout when we could control it, our risk at about a quarter of our original investment. After giving it a chance, it didn't fire, time to move on. So the point of this is that if it doesn't fire, we're not going to come up with excuses and just say, hold and hope, and just hope that we get bailed out with a lucky break. We're going to say, look, it's time to clean that up, move it on, going on for another opportunity somewhere. Another AMD example, this one hit all of its Grand Slam targets. The reason I love this example too, on the far right is where we made our money in just a couple trading days, got all three targets. But you can see over here on the left, we've got the setup of percent R, we got the setup of CCI. The ADX was not quite where it needed to be, but those first highs had to get taken out on a future high. You can see it tried for a couple of bars there, but failed, came back down, and we turn off that setup signal. It is a non-confirmation. That is a fake out that you just avoided because it didn't fit the profile. So there's a lot of those fake outs that we avoid. You can see the next time we get our setup, you can see it happening over here in the charts on percent R and CCI for this high, and you say, oh, isn't that a fake out? The next bar, it doesn't close above there. It does not. But it stays in the overbought territory. So CCI is still good, percent R is still good. And you can see as we get our confirmation on the next bar's close, that's where ADX also confirms and says, yes, we want to be a part of this trade here. So we're hopping in the next morning. Notice where we hopped in that next morning, about 62 bucks. It closed that day at 60. So another lesson is, don't put an arbitrary price stop in right away when you get into these trades. We say give it up to 5 trading days as a time stop. And then if it's not working in the first few days, we'll be looking for a way out. We were wrong on day 1, and then we were very right on day 2 and 3 to get our targets. The stock, you see what we bought? We bought a 75 strike call when the stock was about 62, 20% out of the money, and yet that $1, that $100 a contract we paid, when the stock went up to the low 70s in the next couple of days, the stock's up 15 or so percent. We're up to 300% for that, more than 20 times leverage on that final 300% profit target just a couple trading days later. So you can see that one trading score on these can generate thousands of dollars in potential profit for you. And then when you start stacking those wins and losses together over time, this is not just winners, this is all of our trades, win, lose, or draw. Looking back, basically from the roughly the end of September to the end of the prior month, into the first half roughly, you can see that we had generated $10,300 in profit over a 9-month window before commissions. As you know, commissions have come down. I pay like 60 cents a contract with no ticket charge. You shouldn't be paying more than $1, even if you're not that active of a trader, per contract with no ticket charge. So you keep the vast majority of what you earn. It's gotten so much better than it used to be. We all know past performance doesn't guarantee future results, but this is showing you, look, even if you're putting in up to say a couple grand per trade, that we're only going to generate maybe 6 to 8 trades a month. We're not hyperactive. We're looking for the best of the best, the truly biggest trends. And we've averaged over $1,100 of profit per month over the past 9 months, so more than 10K in profits in that past 9-month window. Remember, this is during a bear market that hit in the S&P and the NASDAQ in the first half of 2022, right? So you got to realize that you do not want to shortchange yourself and basically say, oh, the market's terrible, I'll wait till it improves. You want to be able to say, look, let's focus on the right filters to trade. I'm going to quickly overview these because I know I've only got about 10 minutes before we got to hand it back over to Sherry. So CCI, Commodity Channel Index, Donald Lambert developed at the start of the 1980s to track commodities. I saw its potential to work with big name stocks, especially the big growth stocks. You know, the big tech, the big biotech, the big other growth sectors and individual names is what we like to trade. CCI is a little different than most other indicators because it measures not just the closing prices like a moving average would, but it measures high plus low plus close divided by 3 to get what Lambert called the typical price. So what it basically becomes is a momentum indicator. If we're closing at the highs, you're going to have a pull to the upside. Closing at the lows, it's going to show you a pull to the downside. You average it out. And as I said before, overbought can be very good, especially with CCI and percent R, these tools that we teach you about. ADX, as well as Wilder's average directional movement, this is the one that shows me that are we trending, and is it a fairly early stage trend? Are we? If you wait for ADX to be going up for weeks on a daily chart, you'll probably be too late. You want to catch it as ADX is just starting to get going to turning up and telling us that there's plenty of meat on the bone in that trend. So the DMI line shows us who's winning the war, the bulls or the bears. And then the third leg of the stool is what I call my big trends bands, which is a way to visualize Larry Williams' percent range or percent R indicator. Percent range implies like if a stock's between 100 and 110, and I told you the stock's at 109, you say, well, it's about the 90th percentile of its 10-point range, right, between 100 and 110. It's only got a point up to the top of the range. If the market was static and never broke out to new highs above 110, that would work. I've found, though, that actually it shows me that when it's no longer a range, when it's breaking out into the top 20% of the percent R, Williams percent R readings, that's where it tells me that as it breaks out here, we want to be on that uptrend. The big trends band shows me what's the 80th percentile line calculated as. And notice the change in trend. I should call this percent T now for percent trend instead of percent range, because the idea is that, look, we're moving out of that fixed range with that upper light blue line showing us what should have been the resistance in a trading range. We're moving from range to what? To trend, right? So in just 4 days, we got Baidu calls at 100, 200, 300% profits, and we were done. Now, invariably, someone will tell me, oh, you left a lot of money on the Baidu went huge the next couple of days after we took our 300% gain. Could have made a lot more on the rest of your position. True, but our experience is there's enough of those that can reverse on you even the next morning walking into an adverse gap against you. We don't want that type of risk. So the idea here is that, look, it's all about the top 20% of readings give us the best of the best. It's the Pareto's principle, right? The 80-20 rule. The top 20% of things that you do generate 80% of your results. It's the same thing, especially for buying options. The top 20% of my options purchases generate 80% or more of my profits. So you don't want to be missing these. That's where I see the opportunity to open up people's mindset to what you've been missing and saying overbought's bad. No, you see it can be powerfully good here. Overbought can stay overbought a lot longer than you and I would expect. That's what we're profiting from, is that persistent institutional buying interest on the upside or selling pressure on the downside where they can't get in or out all at once. They've got to gradually work their way in or gradually bail out. They can't. That's why I believe these trends persist. So the indicators are important, but then I think the secret is combining these filters with the option strategy of using, in this case, about a month out options. You say, why would we do that? That added time value gives you more stability than, say, a weekly option. The key is you say, well, gee, look at the 30 days out before expiration chart here on, just assume it's an at the money option. It's all time risk. You say that's got the most rapid decay if you ride it out all the way to expiration. Why would you do that? Well, I'm not riding it to expiration. Remember what I said before, if we're going to say give it a week, and if it doesn't fire in a week, we're going to blow it out, then your hash mark is somewhere in this area, and you see that our area under that curve is a relatively small triangle of time loss. We're not losing all that. And that's why I said in the last 2 weeks of the expiration, don't trade there, don't buy options there, don't hold options there. The decay is, the waterfall of time risk is too great. So for us, we do some selling strategies in the final week or two, and other services that we run at BigTrends. If you're into collecting premium, for example, we'll take advantage of that in the last 7 to 10 days before the expiration. Here I'm saying, look, just give me a chance over the next week, no more than 10 days, but usually about a week is enough. And we'll limit the time risk in that trade. You don't want to buy a 3-month plus option because you have to pay up for volatility. Earnings premium is guaranteed to be jacked up on the options price, and then you're not going to get the leverage potential that you could get with these $1 options. So we combine the powerful momentum with the technical trend indicators that I've developed over 30 plus years of trading experience with the $1 option strategy. It's really demonstrated a strong history of success. As a reminder, so you add it up and look at, okay, the last 9 months, and you can even call our 800 Big Trends line and get our full track record over past years, and it's even more impressive. But this is just trying to show you that, it's worked well even in a bear market. And I think that's the key point, is that most people come with excuses and say, oh, nobody can be making money in this market. There's lots of ways. You just have to know how to maneuver through this. So how do you get access to this opportunity with the Grand Slam option strategy? What I've done here is I've set up a really special traders exclusive offer for you. Normally 12 months of trade alerts for our Grand Slam option service would run, you can see on this chart, actually it's $297 now list price times 12 months, almost $3,600. Plus I'm going to give you a bonus 12 months. I'm going to actually make it a 24-month, 2-year subscriptions access. That would be more than $7,000 in value right there, not counting all of the other bonus educational content. But what I'm going to do is I'm going to slash that $7,000 price point down and say, look, if you act quickly today, you can lock in 2 years of Grand Slam option trades, somewhere in the neighborhood of about 150 trades in the neighborhood for roughly, you can see about $6.50 a trade, $997 total investment for 24 months of access. And it's not just the trades that you get, it's also educational resources. You'll get all my settings. You get a strategy session video, helps you get your settings set up. You'll get the rule sheet that tells you, okay, what parameters, how long of a percent or how long of a CCI, how long of an ADX, and all the other trading rules that you need to know to ultimately help you do this yourself. We'll give you trades and feed you fish, but you can feed yourself as you learn this with my weekly video training every week. Put that out there on my member site access, and you get dedicated email to me and my analyst team. So you add up those other values, it would easily push it up a lot more. But we're saying, look, slash all that down, where you pay many thousands, slash it down. One-time investment, just $997. So where do you go to lock in 2 years access to, for me, what's been the best growth package that I've seen in my 30 plus years of options trading? It's basically going to this link here, members.bigtrends.com/slam. Now notice it's not a www link, so note that if you're trying to type www, it'll throw you off. It's members.bigtrends.com/slam. It's a one-time payment, $997, locks you in. You're basically, even assuming that we'll probably raise the price after this latest run of performance, you've locked in the next 2 years at that one-time investment, $997 for 2 years access. I think you're not going to be just happy but ecstatic with that type of value. Now, let me show you real quickly, since I've got just a couple minutes, and then I'll come back in and see if we have any questions. I want to show you real quickly this page. When you go to members.bigtrends.com/slam, this is what it looks like. It's really simple. And what it is basically you get your key billing information in there, or you can just click the PayPal button at the bottom right, and that'll get you through all your PayPal setup. But basically, you're locking in 2 years of alerts to Grand Slam. Anytime I've got an entry or an exit, we never leave you hanging. You know exactly where we stand on every trade, win, lose, or draw. Okay. The beauty of this is that, and I've already taken the promo code in here, so there's no other further savings on this. This is as low as I can go. 2 years, $9.97. That's basically taking you down to an average over 24 months of $42 a month on average. I'll never sell it at a monthly rate that low. Like I said, $297 a month. You can see if you did that over 2 years, you'd be up to $2,400 roughly. You're saving big money even off of, if you're doing $100 a month, much less $300 a month times 24, right? In the 7,000 range. So the beauty of this is that all you have to do is review the terms and conditions, which are hyperlinked here at the bottom of the page. Once you review that, hit the I agree to terms and conditions, get your info in there, do the PayPal link or the complete your purchase with whatever credit card you want to pop in here. And we're also really clear about if you've got questions, we're here to help. We got live bodies. You don't go through a voicemail purgatory. You say, look, it's 800 Big Trends is our toll-free 800 number. You can call it if you have any questions as you're getting set up here. This will get you ready, by the way, to get my very next trade, which can come out at any moment, during any trading day. You can also email us, clientcare@bigtrends.com. It's listed on the bottom. It's also listed up at the top of the page. If you can't remember our toll-free number, just remember 800 Big Trends. It's an easy way to get us. So let me go back over to Sherry. If we had any questions I need to answer, I'll do that real quick. I want to help keep her on time. And thank you so much for having me, Sherry.
I appreciate you coming. That was a really great presentation. I put the link, members.bigtrends.com/slam in the chat. And I've also put your email for client care at BigTrends on there as well. Someone asked, when was the entry date for this NCLH trade?
Yeah, so I mean that would go back, we look at the chart here. Let me pop it up real quick. To go back and also if you want to email our client care, we'd be happy to send you a PDF of all the slides as an extra bonus.
Oh, there you go.
Yeah,
okay,
but
John.
you can study that. But you see there, Norwegian Cruise Lines, it was recommended on March 28th. So go back and check these charts out yourself. This is an hourly example. We use these intraday systems so that you can actually not just look at a daily chart and wait. You might have to wait a long time on daily charts. The intraday systems kind of get us in even quicker with the same methodology of making sure not one or two, but all three of the indicators are firing at once. It's kind of, I call it the planets aligning. It's like, when you get an eclipse, this can burn your eyeballs if you're not careful. It's like, it's that hot. It's that intense of a power thrust that it really picks up when we see all these indicators starting to say new opportunity. You want to make sure you take advantage of it. So that's when we fire out a trade alert. We'll say buy the NCLH April 21 calls. Don't pay more than 75 cents. Our average entry was 74 cents. We give you a limit price. We give you when to get out at the next target, or if it's time to blow it out and move on, even if it's not working. We never leave you hanging, so you know exactly what to do.
Perfect. Now, there's some other questions here, but I think what they need to do is email clientcare@bigtrends.com and ask for that slide deck.
You got it.
Because they were questions from back in, like the tips slide and how to get the bonus and dates of LI. Is it LL or LI?
LI. It was Lee Auto. It's another EV electric vehicle play. So definitely you want to make sure you're following those kind of names too, folks. So we come back to these names again and again, not just the popular Apples, but the LIs of the world too, because it's like that's where the future growth is. You want to be on the growth train as well to get one of my clients calls it their growth kicker. Like they've got their other investments and their conservative stuff and the S&P funds, but like this is their growth kicker to really give them a way to turbocharge a part of their portfolio.
All right, awesome. So guys, you need to go to the link, get in touch with the email, take advantage of this offer. You're going to get follow-up email. You'll be able to see this on the replay, but I mean, I don't know if it's an unlimited thing. Like you may want to go ahead and jump on it. How many people were you going to let in on this?
We got 20 spots. We can handle typically about that many, and we don't like to load it up too much at any time. So definitely make sure you lock it in quickly, folks, and don't miss out on that next opportunity. That I see a lot of people that have been missing out this year. They're just now in a fear mode, kind of cowering in the corner. And it's like, this is how to take a proactive approach to growing your wealth while managing your risk along the way.
There you go. All right. Well, thank you so much for being with us. I hope you'll come back again.
Oh, anytime. Always a pleasure. Thank you, Sherry, for having me. So much fun.
Thank you. You have a good day.
All the best.
Okay. All the best to you too. Bye-bye. All right, folks, wasn't that awesome? Please do avail yourself of that offer. That is some pretty good stuff there. I'm going to bring up, let's see. And that was Price Headley with BigTrends. Our next speaker coming in is Dean Ashley Bradshaw of Real Life Trading. He's coming to us from Spain, so he's stayed up late for us for today. He is going to talk to us about imbalance and market structure. Dean is on a mission to help 1 million traders become profitable by launching the You, Me, and Trading series brought to you by Real Life Trading. This is a series designed to help futures, Forex, and indices traders revolutionize their results by understanding how to apply the use of imbalance and market structure to become more consistent. Now, Dean, you're going to have to give us your background because I think we switched this up a little bit here today. So let me make you the presenter and then you can take it away. How about that?
That sounds good, Sherry. I hope everyone can hear me. And that was a perfect introduction. I wish I could be introduced like that every time I walk into a room. It was amazing. Thank you for that. Okay, let me share my screen. And let's go to this PowerPoint first. Can you see my screen, Sherry?
Rainbow. Yes.
Perfect. The Union Jack.
All right. There you go.
Okay, guys. So just a brief thing about me. My name is Dean Ashley Bradshaw. In my past life, I did work for Barclays Capital in investment banking for my sins, as they say, in the investor relations department. Today, I am the CEO of Millicent Investors, where we essentially buy companies, owners who are looking for exit, retirement, and we help them plan, and we buy companies in anywhere around sort of 3 billion turnover and under in any sort of sector. The reason why I'm here, I'm a part-time trader. I trade Forex, futures, and options. They're my sort of go-to markets. And I'm a mentor at Real Life Trading UK. And just to touch on what Sherry said, our mission from the 1st of September is to reach out to 1 million traders and help them become profitable using the concepts that we have learned ourselves. And these are not new concepts. They're smart money concepts. It's looking for liquidity and balance, but it's just try to making them more simple. It's like simple plain English for everyone to understand. I have included this link here, and I promise you 2 things. One, this will probably be the least professional presentation that you've seen because it's not in my nature to do this. And secondly, I'm not really good at sales pitching. So this would be it. If you're interested in what we learned today, that you want to find out some more, then you can register your interest here and we'll send you out all the details. The soft launch is 1st of September. And let me tell you, it's going to be I think it works out to $180 for the year, and it's never going to go up. We trade live once a day. So you're going to trade with us. We're going to hold your hand once a day. There's an option that you can upload your trade so we can review it, so we become your online coaching. We're basically putting all these smart money concepts into one simple, easily understandable platform that everyone can have access to. And that's what we want to do. That's why we want to reach a million viewers or traders, is because we're trying to make it affordable for everyone and anyone that is interested in either indices, FX, futures, and so on. Cool, that's my intro, but let's just get down to the actual trading stuff, right? Can everyone see my trading view? Sherry, can you see that? Is that good? I'm assuming that's a yes. I hope so. Sherry, you still there? Okay, let's just hope that everyone can see this. I can't hear anything at the moment, but
I can see your screen really well.
Perfect. Thank you, Sharon. Excellent. Okay. Now, being British, I will try to slow down. If any questions come up because you can't understand my language, then I apologize. I will try to speak as slowly as possible. But so this is the NQ, and you can see all these lines. This is my entry here, and this is a stop. Full disclosure, I haven't taken any of these trades. I don't trade the daily market, the daily time frame. However, this is just the simplest way to explain it before we delve deeper. So imagine trying to get into there with a stop there and catching that swing. And then the same down here. Entry there, stop there, and catching that swing. and so on and so forth. They're big moves in the market. Now, all of these moves, they all have the same characteristics, and this is what we teach. It's smart money movement, and there's going to be a lot of questions. So I'm hanging around after. I'm happy to answer anything that you may have. So where do we start with this? So let's start with market structure. So essentially, what we're looking for to initiate any of these moves are big swings. So I'm going to take away these profit and loss tools just for now, just to make it a little bit more clean. So this would be what we consider the break of market structure. That's the first thing that we need to look for. I'm going to simplify it, but as simply as I can, without giving away all the content that's going to come from our new course and platform that we've got coming on. That's a break of market structure. The reason that's a break of market structure is because we have this low that was put in here, and then we had a big push down. If you can see, we have a really energetic move and a push down. Once we have that, the big thing that is the key takeaway from all of this, so even if all of this becomes confusing, the key takeaway is the displacement in price between these two black lines here and here. Can you see how there is a gap between that? So that's what we call imbalance. Now, there's going to be a lot of people who will roll their eyes at these concepts because it's all based on algorithms, and you have all these large institutions that have bots that are hunting for stops. And whether you believe that or not, that's entirely down to you. However, do some research, and you will find out that a lot of institutions use algorithms and they use bots. And what they're trying to do is create these areas of liquidity in order for retail traders so they can go counter trend for the retail traders effectively. And then what happens here clearly is as it breaks down through this market structure, we get a swing up into that gap before going even lower. So how can you take advantage of that? Well, again, you have the market structure break, you have a fair value gap, and we're going to go into this in more depth in the slides, but I just want to show you what this looks like on real life on a chart, right? Make it as interesting as I possibly can. And how would we know where to target? That's another question that we get asked a lot. How do you know where to target? Well, if you look here, we have sell side liquidity, and that is where this happens here. So the price, nothing goes below that. Now, if you was entering a trade here based on retail information, and it's a really good example here, who's ever heard of the hammer candle? It's like, okay, a hammer candle, here we are, entry there, stop there. That's how you trade a hammer. Retail information, that's how you trade a hammer. And then, yeah, you could have made all of that up here. But we're going counter trend, because if you look at from a daily perspective, you can see that we are predominantly in a bear trend, right? Market's moving down. So we're sticking with our daily bias. We're looking for shorts. So once this happens up here, we get that big push through in terms of market structure. Then the price enters the fair value gap or any price imbalance. Then our target is just going to be where people stops up. We call it stop hunting, which is down here. And price, as you can see, literally crushes through it. And then it shoots back up, which is expected. So how do we then catch the next big swing? Again, same principle. So once these stops have been taken out, we know that there's going to be some form of retracement, right? Because these are sell stops. So once they sell stop here, these are people going short. If the buy to cover their position, forces the market up, which then creates a new high. And we have a temporary low here, and that new high becomes buy side liquidity. And we'll come on to the next phase after. But as that makes a new high and then it begins to retrace again, creating this new low, you can see a short-term rally, but it's a failure to go above this high. So we are still in a bear trend. So I'm not looking to take this bullish at all. We're not looking to play bullish. We're looking, again, for market structure to be broken, which is this candle here. And as you can see, clearly breaks down. And look what it causes, another fair value gap. You see how this stuff works. So what happens then? We set, again, you can set your stop here, or your entry there, sorry, stop above this high here, because this shouldn't be violated. If this area is violated, then we're in the wrong trade, because it could just be breaking up too high in terms of trying to get some more buy side liquidity before reversing down. So that would be your entry, and that would be your stop. Retraces, fills the gap, and then comes down into this area here, which you could have had your target set for. And before we move on, let's just put a line here, just so you guys understand of how we are targeting these things. So if we just let me get my horizontal line, See where the price ended up here. And this stuff just happens all the time. See right there, liquidity. And that's where the price wants to go. That's where the algorithms will take it. It takes it higher, creates a fair value gap, traps retail traders into the wrong area, into the wrong side of the trade, and then goes bearish in terms of the trend and takes out this liquidity around here, which in itself is a fair value gap that has been filled. Fair value gap, this side, retraces, fills that gap, goes to the moon, and then comes back to take this liquidity that is down here. And at some point, it will probably end up being down here. Okay, let's move back. So once that happens, and again, this stuff takes out the liquidity, you get that instant retracement back into a higher zone, and this buy side liquidity literally makes equal highs. But you see how that short-term swing high was here. We crush through that, create a fair value gap, take it down, retraces back up, and then it's almost at equal highs. This is literally what it does. So until that gets taken out, so until we get above this area, for me, we're still in a bear trend. So I'm only looking to play the daily bias. I'm only looking to go short. And take some time on this one as it comes down, because there's a few fair value gaps here, as you can see, but we don't enter them. It doesn't always work. It's not a silver bullet, but it's just a concept to get your head around price action and daily bias in order to be able to take optimal setups. So that one don't work out. So didn't enter the trade though, so you didn't lose any money. Okay, not too bad. This one here could have been, is a very small one. But the key thing for me is this low needs to be taken out before we get in the trade, because that's now the new short-term low. Once that gets taken out, that becomes a market structure break. And we get that on this candle here, this big blue candle. My blue candles are my bearish candles, in case that wasn't clear. So when that candle comes through, now I have my attention. Body closes below that candle. Creates that fair value gap here. Trades lower. Didn't quite get entered there. Would have missed it by pennies. Potentially could have cancelled that trade if I'm looking at being honestly. I probably would have. I've missed it by a few pennies. I'm not going to get into that now. But it does work out just, and then comes down. This one here, full disclosure, I probably wouldn't have got in. I would have left that because of the initial entry would have been short. But just look at the areas where it trades down. So look at all this area of liquidity down here, even down here. And if we scoot over to the left, you can see that we have all of this area that has liquidity underneath it that is coming to get. And once it has that, it reverses, and then that's when we can decide, okay, are we in a bullish trend? Could it go low? Of course it can go low. But all we're trying to do is give ourselves directional bias in order to go and find trades like this. So before I get into how we can find trades like this, I just wanted to show you how it looks like on a chart. And I actually took this trade today in our community, just to show you that it works on Forex as well. So you can see this is the euro dollar, clearly in a bear market. So I knew that I was looking for shorts. We had some areas of liquidity up here. Let me go back to the daily chart. So we had some areas of liquidity, and that's the hourly chart, sorry. Here we go. Here's the areas of liquidity. You can see this big bit of imbalance up here. So in my mind, I'm thinking, okay, what's it closest to? We have some sell side liquidity, and we have some fair value gaps here. So for me, I'm thinking, okay, we need to have a run up, and then we'll go low. I'm going to get into all of this in the slides. I know this is a lot of information at the moment. But here, so 15-minute chart is what we call our bellwether chart, so we get the majority of our information from. And when I zoomed in on the 15-minute chart, we had a fair value gap, which created here. And you can see clearly how price is respecting that. It's wicks are just going in it, but it's not filling it in its entirety. So that was an area of interest for me. I started watching it. And then later on in the day, when this move happened, look at these two here creating almost equal highs, but still respecting that gap. And then we get a big push away from that gap, isn't to say, okay, this could be the trade. And I then go into a lower time frame, which we will talk about. And from here, I start to look for fair value gaps again, but on a smaller time frame. And you can see from the two black lines here, that was the gap that was created. Here's my stop, here's my entry, and it almost just literally fills that gap, gets me into the trade, and then it takes me all the way down. Now, you can see here, full disclosure again, I got out early. This was an area of liquidity, which I did get out at, and it did run on for a few more pips, but this is just to give you an idea of how this stuff works. And if you can piece it all together, then it just becomes, it makes trading a lot easier to grasp if you struggle with daily bias, price direction, anything like that. So that is that in a nutshell. So how do you go and find these trades, and what is the process? And when we was putting these slides together, people were telling me in our company, look, you don't want to give away too much information because we're trying to promote our own company and we're trying to make it a paid thing. And I said, yeah, okay, cool. So I'm basically just going to give you my plan. So you could just have it for free, even if you don't sign with us. Take this information, study the charts, practice it. I promise you, once you start getting your head around some of these concepts, you won't look back in terms of your futures, your Forex indices. It does work on stocks as well, but I've not back tested it enough in order to recommend that. So first of all, the key important thing is finding your daily bias, and it's sticking with your daily bias. Now, sometimes I have a habit of thinking it's bearish, and then I'll see a really good bullish trade set up, and I'll try to counter trend, and then I get stopped out. So if the key thing is find the daily bias and sticking with it. So how do you find your daily bias? So there's a few things, there's 3 steps. So we're going to find out, based on what the market has previously done, what is the current framework? And based on the current framework, then we draw the next, then we start to point out the next draw on liquidity. And then based on the dealing range, or the range of the high and the low, is the market at a premium or a discount? And that's all going to give you information about, okay, are we bearish or are we bullish? And that's all we're trying to achieve here. And if you need these slides after, I'm more than happy to share it with everyone, no problem at all. So step 1, so we need to find out, based on what the market has previously done, what is the current framework? So these are the 3 things that we're looking for. We're looking for any significant liquidity pools, and did it take them out? We're looking to see if there's any significant fair value gaps. That's what it stands for, FVG, fair value gaps, or rebalance. And did the market create structure? Did the market create a structure break with a displacement? And the displacement is just that big energetic move, which we'll go through. So here's a chart that we have, SP 500. So just looking at it here, we're just analyzing it. We're not trying to get in any trades, and forget about this for right now, the daily breaker. This is something that we teach in depth. So that will come later once your heads have got your head around the simple concepts. So just looking at this chart, you can see that these are the highs from December/November, and they got taken out around here. So we know that highs have now been taken out, which is a pool of liquidity. And just look at them equal highs. And this is a real chart. You can go back into the S&P 500 in the minis, ES minis, and I think this is, again, yeah, February time. So you can go back and check these out. This is not something that we've created. So equal highs instantly means that there is buy-side liquidity out there, okay? So buy-side liquidity, we know that's there, it's been taken out. Here is the market structure, because that's where the new low got put in, market structure. So there we go, we've got a swing high, because nothing is high around it, breaks down lower, which creates a new short-term low, and then instantly retraces and breaks through all of this buy-side liquidity. It actually creates a fair value gap as it comes down here, as you can see. Displacement is caused, there you go, there's your gap. If you had, if you were more confident or more aggressive, you can try and get in here. You can. I am not that an aggressive trader. I like to trade the optimal trades where I can. So yeah, feel free to try and take that. But for me, I'm not looking at anything until market structure breaks. So when this bigger move happens down here, now it's got my interest. So now it's broken down, comes into here. So we can see we've got market structure break. We can see there's some displacement, and we can see that it's taking out the previous highs. So for me, we're starting to form a basis of, is this a bearish market? Number 2, so now we've got the framework from what the market's previously done. We now need to look for, where is the draw on liquidity? So do we have clean high and lows, and do we have any more fair value gaps that need to be rebalanced? The same chart, just zoomed in a little bit here, but you can see we have some short-term lows here, which is where the liquidity lies. Here is where so after that liquidity has come down here. No, it's not taking, it's taking it out here. It's not taking it out, I should say. This is the range that we have now, and it's bounced, retraced, and this is the low. So we still haven't taken out this low, but it does rebound straight into this area here, which is something we'll talk about at a different day. But the most important thing is it's created it's gone from created a high, low, and then it's created another high. So the important thing for me is this low that it's put in, this new low, because if that gets taken out, then that's a shift in market. And retail traders will say, look here, you can see that's a double top. Okay, so you've got a double top, which means reversal, but for us, it's all about this bit here. It's about market shifting. So once we get a push below that, an energetic push below that, it has to be energetic. It can't be some feeble move that just sort of somehow wiggles its way down here, like when I ask my children to put their toys away and they literally just take their time to do it. It's got to be when my wife tells me to do something and I just quickly do it. It comes straight down, breaks through. Because now we know that our theory is that the bots are kicking in to try and create some imbalance in order to trap retail traders. And look what it does. It creates a fair value gap here. That low and that low. And a fair value gap is 3 candles. It's the low of one candle and the high of the third candle that creates no prices in between. So nothing meets. So at this stage, nothing meets. And then the rebalance. Retest that gap before going lower. Hope that makes sense. Again, I'm going to be here to answer some questions after, but that's it. That's basically it in a nutshell. If you take anything away from this, just look for market breaks. Did it come down with energy, and did it create some gaps that we'll trade into? Done. So on a zoomed out level, because you have to look at a zoomed out level when you're doing this also, because sometimes previously when I was testing, when I first learned these concepts, I was looking too insular and I didn't realize if there was close liquidity around me or some gaps below me or above me that needed rebalancing. So it was a little bit like shooting at the hip. So advice is what we've learned, zoom out. So these are our intermediate term lows or old lows here, and then our longer term lows at the bottom. So again, looking at it from market perspective and a daily bias, we've already rebalanced this area here. We've had a big push down to change the structure of the market. So short-term lows haven't been taken out, mid-term lows haven't been taken out, and neither has long-term lows. So we're just forming this bias at the moment. I'm not even worried about entering a trade. In our head, we are giving ourselves reasons to say we're only looking for shorts at this stage. So I hope that makes sense. Excuse me, I've had a tickly throat for the last 3 days. I can't get rid of it. Step 3. So now we've got our range, which is the previous high and the previous low. So just in case, is this area here is where that displacement happened. So again, big market structure break, created a fair value gap and a big push down. So it's the range is here, the high, or say here, I'd say the halfway into that gap to here. And this is anything above this middle line, we class that as a premium market, and anything below that we class that as a discount market. So that will give you some help as well to say, okay, if it's trading up here, the equilibrium is 50% in the middle, so it should come down, and vice versa. If looking for bullish trades, it doesn't always work, but it just helps you just get your daily bias. So based on that, with the dealing range, now we're looking for reference points such as the fair value gaps or the price gaps, the fair value gaps, or the shift in price, the big energetic move that leaves a gap in price. Not sure what this slide is, but it's just the same as before. So I think we're looking at this fair value gap here. Yeah, maybe I should have put this slide to give myself. Oh, okay, got it. So yeah, based on all that information, we have all that. We now can decide that we are in a bearish market and we're looking for bearish trades only. So we go from a daily chart, and normally I go for a daily chart, so 15-minute chart, and then we'll look into a 5, 4, 3, or 2-minute chart, which sounds scary, but it's not once you get used to it. But we are see this big move here. Can you see how it took out this liquidity pool? So we had a lot of liquidity down here. Stops. That's all that is, stops. And this is hunting for them. Big displacement, big energetic move down, creating a lot of fair value gaps now. So we've got one here, there's a small one there, just I think, and then here is the market structure break. So we're going back to the old chart, but look from a zoomed out perspective, you can see how this big hammer candle just takes out all this liquidity pool. So when that happens, we have to expect a retracement. We have to. It's the natural course. Again, everything works all the time, but majority of the time, that's what we'd be expecting. So we're not trying to get in early. We're just waiting. We're waiting for that move. So we're waiting for the retracement and then another break of market structure before we enter into a trade. And this is exactly what happens. As you can see here, here is the sell side liquidity. Retraces. Here's the market shift. It gets broken by this candle in an energetic move, creates that gap, and then this is where your entry would be. Enter here, stop above here, and then take it back down to where the liquidity was on the previous slide, so somewhere under here. Now again, this is a daily chart. We put it together on a daily chart just to make things a little bit more clearer. It is a little bit different when we go into intraday, but the daily chart is where we're going to decide our bias. So once we have our bias, and in this occasion, we're looking for bearish trades only. So when that happens, then we have to have two mindsets: daily chart, intraday chart. So daily chart, so again, on a daily chart, every up candle or multiple should be considered a selling opportunity. So have you ever heard that saying, a buy into weakness, sell into strength? And we are targeting old lows on the daily chart or previous day's lows, which we've already discussed. From the intraday, we are expecting the price to go above the opening range, and I'll talk about that in a minute, which is what we call smart money, because they'll be selling that false move to bring it lower into the close. So what does that mean? So we're going to touch upon this as well. I'm going to try and get through these as quickly as I can, but we call this the power of three. I don't know if that's new to anyone, but it's old concepts. It's really good to know, but basically it's accumulation, manipulation, and distribution, which we've got a slide on there. And if we haven't, then I will send it to you. I'm sure we have. But in this range, as you can see, we're looking for this. The opening range, the opening candle goes higher, runs higher, comes lower, and then closes somewhere in around here in the perfect candle. And the way we structure that is this: we'll go onto this chart, understand the direction of the daily chart, and understand how the daily chart forms a power of three, and that's how you get your bias. So again, there's going to be this here will explain a little bit in depth of the power of three and its concepts. But so this is basically what the accumulation phase is. So when price is trading above the opening price, smart money is accumulating a net short book. So they're basically collecting a net short book. They're collecting, they want it to go higher so they can trap retail traders and take them lower, essentially is what they want to do. Above the opening price at close proximity entries is where smart money is going to go short, and we'll show you how to work the CPE entries out in just a few minutes. So I'm going to take a drink of water. I do apologize. Okay, the manipulation phase. The false price move calls at market open or prior to news release is a form of manipulation. The false price move is intended to lead retail traders on the wrong side of the market. And there's a guy called ICT. If you go onto his YouTube channel, he calls it the Judas swing. This is brilliantly stuff. They've got a whole YouTube channel on that, and this is something that, if you want to invest some time in, I would recommend. Distribution phase is where the opposite candle forms at the closing of the candle, and essentially what this means is, without going into any depth, it's just where they just close and get rid of all their positions, and you have this move, what we've already seen. Now, I'm going to show you what this looks like on a chart, but before that, this is essentially the pattern that you're looking for. So even if everything else has been a waste of your time today, if you can just bear in mind for the next two slides, this is all you really need to know. So this is how to use your daily bias and the power of three, especially in this exercise where we're bearish. We're looking for that swing high, which is this candle here, the number 2. It's the swing high. It's the highest candle between these three, right? So none is above it. Once the third candle comes in, this needs to have an energetic move down. If the third candle intraday indicates a reversal, expect the fourth candle to be an expansion, which we're going to show in the next slide. So this is what you're looking for. Right, swing high, next candle, big energetic move below, and then you get the fourth candle. And can you see what the fourth candle creates? Fair value candle. And this pattern happens so often, like literally. After this, if you have time, go and study some charts. This happens so often. So once that happens, essentially what we're looking for is the retracement back into that candle, and that's where we're going to set up our trades. And that's it in a nutshell. If you can find that daily bias and find that pattern, then you're pretty much good to go. There are other ways and other tools that we have to refine your entries even more, but essentially you don't even need to do that. You could just be really cautious. As I say, entry here, stop above the high of the swing high, and then just play it down to the pools of liquidity. So this is what it looks like on a 1 hour chart. Now you have to trust us on this to say that this black line here was the low point of a fair value gap. And this is the power of 3. So again, when is it the opening? Midnight. So if you're trading indices, Forex, or futures, midnight is what we deal with, class as the opening range. So we're looking at the opening here, which is this candle, swing high, swing lower, and then distribute towards the end of the day. That's all that is. So what that's teaching you is, okay, if our bias is bearish and we go back to see what happened on the midnight candle, how did it open? Have we had that swing high? And then now we know we have, we can now look for bearish entries. If it's still going higher, the swing high hasn't happened. So let's just wait until it gets back below the price of midnight candle. That's essentially the power of 3 in a nutshell. There's videos on YouTube that go on about 4 or 5 hours about it, but that's all you need to know. I'm telling you, everything else is just absolute fluff. Again, we're just looking at a 15-minute chart on what that looks like. So here we are at midnight. Candle opens, we run higher, we don't break it. See, we don't break it. Liquidity is starting to gather. That's all these wicks or tails, whatever you want them. They're starting to gather. We're going below it, but we're not closing below that. So the swing still hasn't happened. Then we get another swing, and then we get the energetic breakdown, breaking market structure. See, all that gets broken, takes up by that candle, and then essentially that's your candle that comes down, and then this candle and this candle form that gap. And that's where you would enter here, stop above here, and then you push through. And even if you didn't want to get in that one, it gives you another gap here. Even bigger move down, gap. Trades into the gap and then sells off in the afternoon. And this pattern, again, happens very, very often. So that's basically for using it from the opening candle. Now, if you are like me and you trade Forex, futures, indices, then news has a huge impact. So you have to be careful if there's news in and around the time that you're looking to trade. So we can see again from here, down on a 5-minute candle now, we have the opening candle at midnight. We have a swing up, creates a little gap in here. If you was very aggressive and confident in your ability, you can wait till that comes up and trade that down. For me, I need to wait till market structure has been broken before I take a trade. So sometimes I do miss trades. There is opportunities that come up here and then we just get to the bigger push down and I miss trades. But consistently, if you stick to your plan, then you should be profitable. So 8:30 is when the news embargo lifts, and we normally get some news that come out. It's Eastern time, by the way. And as you can see, as we come back down after that big push, another fair value gap is created here. We have a slight run up to the news, taking it in the other direction before a big push down, creating another fair value gap. And that would have been a one that you could have got in here. For me, the one I get into would be this one here. Push down, another gap. News is coming out at 11, which is here. And it runs up into it, causing retail traders to think, okay, look at this beautiful hammer. Entry here, stop here. We're going bullish, and no, rejects, because we're just rebalancing that price before going lower. And that's exactly what I said here. Notice that the false price move are not random. They perfectly hit these fair value gaps. And you can see that. Like, this is real charts. Go and look at these. They just hit that gap all the time. Now, am I saying that when you see that, take it and you're never going to lose a trade? No, sometimes you think you're in a bearish bias and you set up the gap, and it not only fills the gap, but it just runs on to take some buy-side liquidity and gets you stopped out. But that's just the luck of the draw, right? That's trading. If you think you can't lose money in trading, then you're in the wrong game, which is day trading, and we're trying to generate cash flow. So again, you have losing trades. The difference is is that you have more winning trades and losing trades, and also the risk to reward by doing stuff like this is completely different to anything I've ever done before. So here's a little tip for how to know when to enter trades. This is, for me, again, huge takeaway. My team said, Dean, don't give this away. And I said, okay, but I'm going to give it to you again anyway. So essentially, this is how we call this the close proximity entries. Can't say that word. That's sort of made me stumble here. So we look at the power free. So essentially, if you remember, we have the open price. It runs up to the high of the day, and then it comes down. What you need to do, or what I have learned to do, and it works pretty well to give you a window opportunity, is whatever the distance is between the opening price and the price high, subtract that from the price low. Don't forget, we're going bearish, it will be conversely so if we're going bullish, and then that's your trading area. So we'll trade between the opening price and the 1.1 deviation. And what does that look like? So same chart, 5-minute chart before. If you had bulls and you was up here, brilliant, because you got into that trade and you just made a killing. For me, no, I'm nervous. I need to make sure that I'm entering at the most optimal times. So this is the midnight, as you can see here, opening candle. That same distance between here and the high is the same distance between the opening and here. And that is where we call your close proximity entries. So both of these fall into it. So that's into the trade now. So here you could have got into it, fair value gap, entry here, stop above here, because you want to stop above here anyway, because that is the new interim high, which shouldn't be broken or shouldn't be violated. And if it is, then we've got our bias wrong. So that would be my stop. And I would short that down to any form of liquidity looking to the left on a bigger time frame. If you missed that one, or you was still waiting, which is normally me, this would be the one you get into. Now, this is the fair value gap on a 15-minute chart, but you can just pick that area out on a 15-minute chart, and as long as you've got that clearly, when you go down to a 5-minute, then you can just set up your entry based upon that. And that would have probably been the one that I would have taken. I would have got in a bit lower. Again, I'm not as quick as other people. Joey, my colleague, would have probably got in up here. He's faster on the trigger than me. I'm an overthinker. And that's it. Write it up, and then distribution in and around close of market. And you can see very faintly, you can see we have the power of free tool. Okay, open candle, up higher, trades lower, and then distribution in and around here. So once you have that, then we do something called top-down analysis, and it sounds a lot more involved than it actually is. But once we have the displacement, then we start looking for the smaller entries. So we're on a 15-minute chart to get most of our information. And then we go down into a 5, 4, 3, 2, and 1-minute chart looking for the fair value gap. The big thing here is, and this is where a lot of people go wrong, is if they see a fair value gap on the 5-minute chart, they still go and look at the 4-minute, the 3-minute, or the 2-minute. But what they should be doing is looking for fair value gaps. And if you find one, then you don't have to move on. So here is just like we remind people, 5-minute chart, no. 4-minute chart, yes. You don't need to go down to 2 or 3. Here's the gap. Play there. Hope that makes sense. Cool. I said it was going to be quick. I'm sure there's going to be loads of questions, especially because of my city accent. A lot of new concepts and a lot of new words, but anything that you have for me, I've got the next 10 minutes to go through anything that you need.
4 minutes. But
4 minutes, there you go.
There is a couple of questions that you might not be able to see, but I can read them to you. When you're talking about midnight or afternoon, are you referring to New York, like to the
EST.
stock?
Correct. Yeah. I trade
So you're
everything
talking about London
in
time,
EST.
you're talking about New York time, which would be ET.
Correct. Yeah. It's everything is EST that I do and that we do on our charts. Which, yeah. So just so that so you know. And I should say the optimal time to trade this as well, by the way, is 8:30 to around 8:30 in the morning EST to around midday. If you're trading futures for Forex, probably around 7:30 to around 11 a.m. all New York time.
Okay, cool. Now, have you got a link that you wanted me to put up for you? Just you want me to do Dean at Real Life Trading?
Yeah, well, you can do Dean at Real Life Trading. The other link, if I go right back to the beginning, is if people want to learn more about this and become part of the community, then we have this You, Me, and Trading series, which we're launching. And again, what we're trying to do is going to be a community that is going to teach this concept. We've got loads of online courses that is going to teach this concept. And then me and my colleague, we trade live every day, Monday to Friday, for an hour, hour and a half. And we just try to look for trades together, setups together. People can upload their charts and we can give them some critique as well. There's going to be that facility. And that's going to be $180 for the entire year. That's it.
Oh.
No upsell. We don't want any, and it's never going to go up in price. We're trying to create a community of financially free traders or people that can use what I do. I use trading for cash flow so I can do other things with my life. That's what we're trying to do.
Excellent. So I put up HTTPS and I did www.reallifetrading.co.uk/you, me, and trading.
Perfect. Yeah.
Okay. All right. Awesome. So do we got any other questions? I think I see somebody. Let's see. What was FVG?
So FVG is the fair value gap. So that is essentially the gap that is caused between the displacement of a large energetic candle between three candles, like this one here.
Okay, cool. That, and I think anybody else have questions? We got 1 whole minute.
Oh, who's got it? It was that terrible that no one wants to speak.
Well, actually, it was probably that informative that they've got all the information they need. They're busy filling out their forms, right?
Let's hope it's that one, Sherry.
All right. Well, I appreciate you coming. I will absolutely invite you back again, and I hope you'll accept.
Obviously, I will do. I love being here.
And I appreciate it a lot. So everybody take advantage. I put the email in the chat. I put the link in the chat. You're going to hear from Dean. You're going to hear from all of our speakers. So please take a look at their offers. And Dean, have a wonderful day. Thank you so much for being with us.
Thank you so much for having me. Have a good day, guys. And I look forward to hearing from you all. Cheers, Dean.
Awesome. Thank you. All right. Boy, we're moving right along. And I'm going to just do a little bit of housekeeping here. My screen, got to go from the beginning. So our next speaker up is Nick Lovelace with the Super Trader. And he's going to talk to us about why you get in and out of stock and option trades at the wrong time and how to fix it. That's going to be pretty powerful, I think. So just a little bit about Nick. If I can get my thing to scroll here. Okay, cool. All right. Nick is the founder and head trader at thesupertrader.com. It's a website that specializes in using options and stocks to generate consistent monthly income, as well as long-term capital growth. He's also the chief investment officer of Alpha X Capital LLC, which is an asset management firm for accredited investors. Thanks for joining us, Nick. How are you doing today?
I'm great. It's been a long day so far. I just hope people are still hanging around.
Hey, we've got quite a few people still here with us, and they're going to be glad that they did.
Proud. Yeah, they will. We're going to make this real good.
I'm going to give you a presenter. Now, do you like to see the organizers' questions on the fly? Do you like to wait until the end?
Yeah, that'd be great. I can, if you want to.
There you go. I did it. I can see your screen, but we can see your whole presentation. Okay, just good deal.
There we go. Is that the right view? Perfect. That looks good. Awesome, you guys. Okay, let's get going here. Let's just jump right into this. We're going to do some trivia, so get ready, put your trivia hats on. The goal today is to give you a really, really, really ridiculously simple way of getting in and out of positions at the right time. This is your number one fundamental issue. Everything that I think anybody will ever probably talk to you about is attempting to show you when to get in and when to get out. And there's a harsh reality, and that is you and I don't control the markets, but there is a force that does. And I found, after spending a lot of money myself, going through and using indicators and technical analysis of all sorts, that following these guys, the smart money, the Bridgewaters, the Goldman Sachs, the JP Morgans of the world, following them is the fastest, most reliable way for you to get in and out of positions at the right time. This will skyrocket your win rate and your profits as well. So with that said, here's our trivia. Everybody find the chat here. Let me make sure I've got the chat. I think I do. I think it'll show up in the questions panel here. Everybody say aye, hi, ready, ready, ready. Tell me ready if you're ready to go. Who is this? Who is this? For $100, the first person to let me know is going to get $100 on Amazon. We'll send you an Amazon gift card. Okay, who is this? I'm going to give you a hint. 8 years, I'm speaking in his voice. 8 years after starting a hedge fund from my dorm room, I had lost tens of millions and went totally broke. 8 years after starting my hedge fund. Warren Buffett, Juliana says, nope. There's $100 on the line, you guys. Any other guesses? Anybody want to throw anything out? All right, I'm going to give you another one. I had lost so much money, I couldn't afford to make ends meet. I even had to borrow $4,000 from my dad until I could sell our second car. Larry Flint, Manasseh says, nope. Well, we've got a lot of people here. 2 guesses for $100. Any other guesses? Thiel, Jobs, nope. Good guesses, O'Brien, Tom. Michael Lewis, John, nope. Not me, Juliana, not me. Founder of Robinhood, Irving just doesn't know. He's just giving in. Okay, how about now? Do you know who this is? Andrew Larson, my friend. You just won yourself a $100 gift card to Amazon. Just shoot us a message to support@thesupertrader.com and let us know that you were the first guy to answer. We'll shoot you over a Amazon gift card, Andrew. Yep, Mark, you're right. Ray Dalio, Bridgewater Associates. So how does this matter to you? I really like to look at Ray because he's not a guy that he's very hard to relate to nowadays because of where he's at. He's founded Bridgewater Associates. This is the largest hedge fund in the world. They manage over $160 billion. It's the most profitable hedge fund in the world. I mean, just consider 1/10 of 1%. That's 0.01% of the assets they manage is still $160 million. And after about 8 years after he started his fund, he was totally broke, couldn't make ends meet. His story goes like this, okay? 8 years after he started, lost tens of millions, went totally broke. And this is how it happened. In 1982, he predicted that the economy was headed towards a depression, and he shorted the market in a big way. How many of us have shorted the market in a big way thinking that we're going towards a depression? Okay, he did that in 1982. He says, I was dead wrong. The stock market began a big bull run, and over the next 18 years, the US economy enjoyed the greatest non-inflationary growth period in its history. He says, my experience over that period was like a series of blows to the head with a baseball bat. If you have not experienced that, you probably have not been involved in the markets long. He says, being so wrong, and especially so publicly wrong, was incredibly humbling. Cost me just about everything I had built at Bridgewater. I had lost so much money, I couldn't afford to make ends meet. I even had to borrow $4,000 from my dad until I could sell our second car. But he says this. He says that in retrospect, my crash or failure was one of the best things that ever happened to me. I saw that to do exceptionally well, you have to push your limits. And that if you push your limits, you will crash and it will hurt a lot. You will think you have failed, but that won't be true unless you give up. I like to start this way because I know that so many of us have been at this for a long time. I mean, today alone, you've invested close to 4 hours of your day learning or trying to learn from the experiences of others. And I know that there's a lot of frustration. There's a lot of those of you that feel like, will I ever get this? I love looking at Ray's story because he's not a guy that started from the top. He's a guy that started from the bottom. And even after 8 years of doing it, lost tens of millions, went totally broke, and still managed to wind up creating a firm where he's got over $160 billion under management. I like to start that way to give you hope. I'm confident that you're going to get this, and I hope that today the things that I have to share with you can contribute in some small way to your pursuit. So on to our topic. See, it's my belief that following the smart money is the fastest, most reliable way for you to enter and exit positions at the right time. It dawned on me, this dawned on me years ago. I was watching a presentation by JP Morgan Chase. I was watching their Investor Day. Who you've got to be a real addict to the market to watch JP Morgan's Investor Day, but I was doing it, okay? And in their Investor Day, they got to a slide where they showed their trading business. JP Morgan's a massive bank, right? And they're in a lot of different businesses, including baking, but they're also in the trading business, in the stock market business. And when they got to their slide deck where they showed their trading results, okay, let me just show you this real quick. I'll pull it up. This was way back in 2017. This is when it dawned on me, man, I'm trying too hard. These guys are onto something, and I got to find a way to just start participating with them. Okay, so here's their markets business. Okay, over the course of a 5-year period of time between 2012 and 2016, they reported the number of losing days that they had as 9. You figure you've got 250 trading days or so in a given year. And over a 5-year period, you're talking about 1,250 days, they only had 9 losing days. That's a 9.38% winning rate. And it goes beyond that. Look at their average daily revenue. This is in the millions of dollars. So throughout 2012, it was 69 million, 72 million, 67, 70 million per day, and 80 million per day in 2016. This averages out to be about $70 million per day on average, and they only had 9 days where they had a loss. This is on a scale of just, it's an ATM. That's all it is. And this is when it dawned on me that I was fighting up against a force that was so much larger than me and so much larger than anybody that could teach me, that I decided that I was going to make it my pursuit to participate with these folks. And we developed some algorithms and some ways that allow us to do that. And that's what I want to share with you here today. So I manage a hedge fund called AlphaX Capital. This is for accredited investors. Basically, we make rich people richer over at that fund. And we manage, we brought those systems over to the Super Trader for retail traders to be able to participate with institutions instead of fighting against them. And we make that really, really easy. So this is me. This is my family. We've got 6 kids. I enjoy doing anything outdoors, flying, fishing. Got my pilot's license when I was 16. I attended Brigham Young University for finance, and after going on a mission trip for my church and my experience, I founded, I'm the chief investment officer over AlphaX Capital, hedge fund for accredited investors, and then one of the head traders over at the Super Trader. So what I'm going to show you today, we're not talking about just incremental results in your pursuit to making this work. This will change everything for you radically. There's no guesswork in it. I got this email from Joseph. He sent me this. He said, I've been using this system for almost 18 months now. Have not seen anything but the exact results Nick describes. Like most people, I was skeptical and cautious at first. He said, I started trading in paper for the first 2 months, and then I slowly transitioned to using money in a taxable account. Once I saw that I could follow the system, that it worked, and I'm all in. Now my biggest problem is that I am growing this account so quickly, I have more tax to pay if I want to convert this account into a Roth, which would provide a huge tax advantage savings in the future. Now that I'm all in with this investing technique, I'm currently generating an average of $50,000 per month among all my accounts. This is the first thing in my life that I've seen that was truly too good to be true. Thank you, Nick, for developing the system and sharing it with everyone. You've really changed my life. So this, I want to be full disclosure, this has everything to do with the breakthrough that I had, and that was that everybody that I had learned from, they weren't the smart money. They couldn't control the markets. They had some indicator or some technique or some methodology of trying to time things, but none of it was controlling the market. These guys, the smart money, they are just right all of the time. And if I can just distill upon you anything at all today, it would be recognize that you do not have control, but there is a force that does, and your best path forward is to participate with, not against them. So let me just dive down into this a little bit further. This was crazy to me. The FINRA, our regulatory authority for the financial industry, they actually recognize 2 core groups of traders or investors. Whenever you fill out your brokerage application to open up a trading account, they're basically trying to classify you as professional or non-professional into one of these 2 categories. Almost everybody here, even if this is what you do all day long, every day, you are almost guaranteed to fall under the category of non-professional. In fact, the FINRA goes on to state on their website some key distinctions between what non-professionals do in the market and what professionals do. Non-professionals generally, their individual buying and selling has no major impact on the direction of individual stocks or the market overall. Professionals, however, They account for as much as 70% of all the volume. And because of their dominance, institutional buying and selling leads to big price moves in individual stocks and the market overall. So I'm going to use this term a lot today. Institutions, smart money, professionals, it's all the same thing. These are pension funds, hedge funds, banks, insurance companies, other large, big investment firms. All right, that's who we're talking about. So how do we do this? How do we follow the smart money? Well, it's kind of like looking at a black hole. All right, this would be a Hollywood portrayal of what a black hole may look like, and we're even just recently making leaps to even be to where we can actually see a black hole. But this is what they look like from what we think they look like, but this is how we actually see them. All right, on NASA's website, they say this: astronomers can detect black holes by watching for their effects on nearby stars and gases. Okay, so you've got these stars orbiting in space around something that's just dark. There's nothing there. There's no star that they can see. It's just dark space that these stars are orbiting around. And that is how we are able to identify a black hole. This is the largest, most powerful object in our known universe, and we can't see it. But because it's so large, it impacts things around it. And that's how it is for these big institutions. Remember, they're managing over 70% of all the volume that comes into the market. It's coming from them. And so they are going to impact things around them that leave a footprint behind. So there are three effects that we can look for to know where these institutions are doing their business. And I think it was somebody that mentioned today that the smart money uses algorithms. And that is so true. They don't have some individual looking for MACD crossovers or looking at CCI or DMX or DMI or ADX or other moving averages or any other tech. They don't have somebody looking at these things and saying, oh, I think it's a good time to get in. It is all just mathematical and monitored by humans, but executed by computers. So it's repeatable, it is predictable, it is consistent, and if you understand how they operate, you'll never have to draw another line in your entire life, and you can get rid of every indicator that you've got because you don't need them. You need to learn how to follow these guys who are making 70 million per day. All right, so I'm going to show you today how to do that. But here are the three effects. If you're going to write this down, this would be a good time. Okay, the three effects that institutions or the smart money has on price. Okay, that is to say, the up and down of the market, okay, is what we'll refer to today as the auction. It's just there's a computer that runs it, and its only job is to search for where business wants to get done. All right, it's kind of like an auto auction or a home auction. Okay, the auctioneer's job is to find where business wants to get done. He'll start the auction. Do I have 5,000? Do I have 5,500? Do I have 6,000? Do I have 6,500? He is going to try and get price to where business can get executed. And when he finds that price, the auction is over. All right. And that's very similar to how it works in our marketplace. It's just an auction. And there are three different profiles that get generated in the auction of the market. We have what we call price clustering, or consolidation is another term that is used, chasms or gaps, and we have vertical imbalances. Now, price clustering is just chaotic, back and forth. It doesn't have to be directly sideways. All of your patterns, okay, your wedges, your pennants, your flag patterns, your symmetrical triangles, all of those are clustering type patterns, all right? Chasms follow clustering, and price then rapidly moves. Then you'd move over to here. It rapidly moves where you have a series of higher highs, higher lows, or the opposite, lower lows, lower highs if you chasm lower. All right, so institutions make up 70% of all the volume. All right. In which of these three profiles do you think 95% of all of their business gets transacted? What do you think? Institutions transact their business in only one of these three profiles. Brian says clusters. He's spot on. Okay. A, clustering, this is where institutions are transacting their business. Now, I'm going to prove this to you, but let me just walk you through the thinking here. You're right, Irving. Yep, exactly. Okay, so think about it this way. If you are an institution and you want to buy shares of XYZ, there may be, let's say you want to buy, $20 million worth of XYZ. Right now, there may only be a certain number of shares available at the current price. We're going to say the current price is right here, 100. And we're going to say that there are currently 10,000 shares available to be purchased at 100. This is just an auction, folks. There is a seller on the other end of all the transactions. There's a buyer on the other end of every transaction. Okay, so if you come in and you are XYZ, or you're a big firm and you want to purchase 20 million shares of XYZ, and that's trading at $100 right now, that means if you could buy them at 100, you're looking to purchase 200,000 shares of this particular stock, but there's only 10,000 available right here at the current price. So if you came in and you attempted to purchase $20 million worth of these shares at the current price, only 10,000 would be filled. And what would immediately happen is the auction of the market, again, the ebb and flow, okay, that up and down movement, it's going to start to try and accommodate your order because you're a big participant. It wants to get your business done. So what it will do is it's going to raise price to go and find sellers, all right? So it's going to come up here. We'll just say it's not going to move all the way up to 105 necessarily, but just for example purposes, we move up to 105, and between 100 and 105, we find another 40,000 shares available, okay? Well, I still don't have my full 20 million invested. What will continue to happen is if you were to submit this order at a limit order, it's going to keep on moving up price, 107, 110, until this entire order is filled, 120, or maybe, okay, you've got another 50,000 shares filled here, you got another 10,000 here, okay. I think I just, so, we'll have another 40,000 up here. So anyways, the auction of the market is going to hunt for enough sellers to satisfy your buy order. And the moment that that is done, what's going to happen to price? It's going to come right back down. So this is obviously, if you're an institution, if you're this big buyer, you don't want to move price way up, get filled all the way up here, then just to have it come crashing right back down on you. That is not a great strategy for you, all right? And so what institutions do is they are slowly getting into their positions, and they are slowly getting out. Now, sometimes you have what's called a fat finger trade, where a big institution will sell all of what they want or buy all of what they want, and it will do that. It'll come crashing down and then going right back up, flash crashes. That can happen to the upside as well. If they come in and try to buy a ton all at one time, it'll skyrocket and come all the way back down. This is not how most institutions want to be getting involved or getting out of the market. They want to do so in a more orderly fashion. So that's the logical side of it. Let me prove it to you by looking at a chart. So we're looking at Facebook here. Facebook reported earnings. This was back when earnings were good and they weren't looking like their dying company, but great earnings. And all of a sudden it gapped up. The next day it opened up 8% higher. All right, 8% higher. Now, how many of you think that it gapped up because some big buyer bought a bunch of stock the moment that that earnings release came out? What do you think? Think that's true? You think that some big institution bought the moment that that news hit the wire? No, yeah, Irving would be right on that, okay? Matt says it has low volume. You're right, it does. And what we can do here is we can look and see, remember, institutions, these smart money traders, they make up 70% of the volume. So where were they trading at? Let's look at it. I'm going to slap up an indicator here. This is called volume profile. It takes volume and puts it on a horizontal axis and shows us where volume traded at what price levels. So these little green nodes, okay, we had a lot of volume in here, had a lot of volume in here, had quite a bit in here. Then earnings came out and you had price go way up, okay, just gapped up. Look at what the volume did. Like Matt said, there's not much. Look at where the volume started to come in again. What's that price pattern called? I just told you, clustering, okay? Clustering. And then it went way up. Look what volume did, got really thin. All right, and then look at where volume came back in again in our clustering pattern, okay? So, a couple of things. Number one, you don't control the market. You have no impact on price, but there is a group that does, and they're making a ton of money and taking your money day after day after day. People like JP Morgan, 70 million per day, 99+% accuracy rate. So that's the truth number one. Truth number two, your best path forward is participating with them and knowing where they do business, because they are primarily running mathematical algorithms, computers that are running their trading for them. The levels that they go to are predictable. Now, if you're looking at this chart, you could break it down and do all sorts of analysis, use fibs, use candlestick analysis, use what the previous gentleman said, you know, oh, here's imbalances that occur. Like, you can do all sorts of those things, but how do you know that it's going to come up here before it ever goes up there? And that is where, again, we can follow the smart money very easily, and that's what I want to demonstrate to you right now. So give me a chart, any chart here. It needs to be liquid, something that lots of institutions are participating in. Okay, so give me a chart. Okay, we've got lots of SPYs here. All right, and just so you know, I am not doing this. This is not my own pick. Here's a snapshot of the chat thread. All right, SPY, SCCO, SPY. All right, so these are not my own. I'm going to do this with a clean slate. So let me show you how to do this, okay? All right, So let's go look at a 25 plus period of time. The internet was really coming online over here, right? This is when algorithms started to take over. This methodology has worked since then. It will predict 95% of all your tops, all your bottoms, and you'll never have to draw another line again. It will predict the high before COVID, the low after COVID, the high that we came in here, the low that we just came in. You'll never have to draw another line again. So here's how we do this, all right? I'm going to focus on just a period of time away from right now to do this. Remember, institutions, they're doing business in those clustering pockets. Clustering, 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 okay? This is where they do their business, all right? You have these vertical moves, okay? You have some, you're not gonna see a lot of gaps because I'm on a weekly chart, but you get some in here, okay? So what we're gonna do is we are going to attempt to try and decipher their algorithm, all right? So what I'm gonna do is I'm going to connect clustering zones because this is all connected, all right? What a lot of people do is they come in here and they're gonna draw lines like this. So they've got something like this, and then something like this, and then something like this, and then something like this. They've got lines all over the place. That's one form. Or they're going to draw horizontal lines, all right? And all they know, they can't know where peaks are going to be because they don't know that until it peaks out. So they'll come over, draw horizontal lines once it does peak out, but that's still hindsight. You can't know that until they look back for a little while. They'll draw horizontal lines here, they'll draw boxes, they'll draw everything, okay? So this is how most people perform analysis, and it's random, it's not predictable, and it's confusing. This way is simply deciphering the algorithm that institutions are operating by, all right? So here's what we're gonna do. We're going to attempt to connect these clustering pockets. Now, companies are designed to make money. There's not a company that trades on the public markets that its purpose is not to create wealth for its shareholders. It does that by increasing value as a company. And so the auction, your lines will always be going up in an upward trajectory, okay? That's truth number one in identifying where institutions are going to do business. Second of all, they do business in these clusters. So we're going to try to connect these clusters. So here I've got a nice big clustering pocket. This is a weekly chart. Each one of these candles represents a week-long period of time. So I'm just going to go over here to this high, and I'm going to draw a line that comes across here. And I'm going to create just a little zone here for price, okay? So that is my first zone where I'm saying that, boy, when you're below this level, I'm always going to assume that institutions are going to sell and distribute when you come into this level. After I break above this level, I'm going to assume you're going to go to the next auction zone. Well, where's the next auction zone? When I say auction zone, I'm talking about where institutions are going to transact business. So what I'm going to do here is I'm going to simply duplicate this line or this set of lines, this first zone. I'm going to drag it down until it looks like I'm crossing through what appears to be another set of connected clustering highs and or lows, okay? So notice here, I get clustering here, it rejects, clustering all in here, it chasms, okay? Typically when you break an auction zone, okay, normally when you break an auction zone here, you're going to gap. You're going to chasm away from it. But then I have, boy, it tested it back down in the zone there, tested it back down in here. Nice multiple weeks of clustering in here. Okay, again, it falls off of a cliff. Where does it stop? Right in my auction zone. Same thing here, falls off a cliff. Where's it stopping? Right here in my auction zone. So that's going to be the first attempt that I'm going to make at these, at the structure that's going to be identifying really what I call the market matrix. All right. So now what I'm going to do, this part is really easy, is I am going to multiply all of these all the way up, all the way down, and each one of them is going to be the same distance apart. So I'm going to get a little rectangle tool. I'm going to measure from the top of my top zone to the bottom of my bottom zone. And now what we're going to do is we're just going to build out this matrix down and then up. And if we've done this right, this framework will predict nearly 95% of all of our tops, all of our bottoms will happen inside of these zones. All right, if I have done this correct. Now I'm just eyeballing this right now, but I'm going to keep coming down here. And we're going to check back in time to see, did this work with predicting the 2008 lows? Was it right in my auction zone? What about other lows? All right, here we go. Now let's zoom out and take a look. Okay, so it's pretty good. Notice pre-2008, look at where we were clustering at. When we drop down, look at where we found support right in our zone. Remember, I drew this set of zones just with this data right here. All right. Thanks, Matt. Matt says you're doing great. Thank you, Matt. Okay. So here we're clustering, and then it breaks. Where does it go down to? Rapid break, 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 and it stops right in our zone. All right. So this is a little sloppy, but for the most part, not bad. Okay, when it goes up, where does it stop for multiple weeks? Right in our zone, up above, right back down to our zone, right back down to our zone. Where does it go up to? Right to our zone, right back down to our zone. Okay, this works on all time frames, Matt. Okay, institutions are running programs on all time frames. All right, so pretty neat, huh? I mean, we created these set of parallel lines just from this data alone, and it just so happens to be that the 2008, when the financial crisis hit the European area, we were right in our auction zone, came right down, right to your auction zone. Okay, broke above it, came back down, auction zone support. 2008 low, right in your auction zone. Okay, so pretty neat so far, but let's keep going. Let's keep going here and build this up and see what it reveals to us with more recent stuff. Boy, look at this. See little things like this. Look at where it rose up to. Right to your zone, stopped. Okay, inside of your zone, exploring, comes back down to halfway of that and goes up. Okay, it's not happenstance that it takes a pause here. That is an institutional business area. And so price is always going to take a pause there. Okay, let's keep building this up and up. We got a little steep hill here to go through 2021. Boy, how about that? Okay, 2018, right in my auction zone, right down to my auction zone, clustered there for multiple weeks, broke. It took 3 weeks to get down right to my auction zone, right up to my auction zone, right back down to my auction zone. Clusters around this one in a sloppy way. and then pursues a next one. Look at the 2020, the pandemic low. Do you see that? Right in our auction zone. How about that? Once you have this framework, you're never having to draw another line again, and you only trade within this framework. This is on a long-term time frame, but this is also something that is done on other time frames, all time frames. Matt says, measured move, super impressed. It is one of the most eye-opening things when you realize that it is a matrix, it is predictable, and it's been there under your nose the entire time. I mean, look at this. Okay. Zone, 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 breaks out up above, comes back down, zone. I mean, I drew these all the way back in 2015. It has nothing to do with 2021 and 2022. Yet, because this is all an algorithm, the way the institutions are operating, it's predictable where they're going to be doing business. Look at this. May of 2021. It took 3 weeks to get up to this zone, and then it stopped there for 12 weeks. You see, I mean, just perfectly right where these are all the same distance. And nothing fancy about this other than it decrypts how things actually operate level to level. All right, and we'll do one more here. Okay, so as we look at recent stuff, all right, okay, right into your auction zone, right back down to your zone, right back up to your zone, right inside of your zone, right back up to your zone, right back down to your zone, right back up to this one that's a little bit sloppy, but goes down, 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 clusters here for a little bit. Where did we just hit? Right inside of this auction zone, okay? Where's this thing going? It's going up to here. That's the presumed area where we're going to be going up to, okay? So as you look at this, you're going to see, just let your eye gravitate. Almost every single top and bottom should be within this framework. Now, again, I just eyeballed this really quickly. Let me just take you over here to one that I've already got well established. Over the past 20 years, this is using shorter term auction zones. This is on a 2-year framework, but they work, it was mapped out on a 2-year framework, but they work for the past 25 years, okay? Auction zone resistance, support right in this zone, support, resistance, support, resistance. Auction zone goes down, hits your auction zone there, bounces back up to that one, drops, drops, drops. Auction zone, auction zone, auction zone, auction zone, auction zone, auction zone. Stalls there in that one. Zone, 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 zone. Okay. 95% of all my tops, all my bottoms are going to fall within this framework. Look at COVID. Okay, where were we trading at going into COVID? We were running up into an auction zone. Now, you don't know that a COVID thing is going to happen, but when you're going up into a zone, you need to be defensive. You've got to be defensive. You're not saying that the bottom's going to fall out and go all the way down to here, but you're certainly going to be protecting bullish positions as you rise into zones until you break out up above them. You can get into bearish positions, but you've got to be cautious for breaks above those zones. Just because you're rising up into a zone doesn't mean it's going to drop like a rock and go all the way back. All right. But this is a framework that will predict nearly every single top and every single bottom forever and ever and ever. All right. You never have to redraw your lines ever again. This is how it operates. This is the algorithm. This is how the auction of the market operates. Okay. So it's my conviction as a manager of a hedge fund, I have had experience with moving the market myself. Early on in our company, we tried to buy $2 million worth of stock and found that we moved the market against ourselves. And so institutions, in order to avoid that, they use algorithms that are trading mechanically for them. Matt, you caught me, man. And it's predictable. As you could see in JP Morgan's Trader Day, Investor Day, they've got that 99% win rate, $70 million per day on average. And here you are trying to earn an average of $200 per day and have spent thousands and thousands of dollars on courses to try and make it happen. Your best path forward is to follow the smart money. Learn how to follow the smart money. It will change everything for you. So there's three things that happen in the market: price clusters, price chasms, and vertical imbalances. Everything, all of these happen because the computer that's attempting to fill orders is trying to fill the orders for 70% of all the business that's being done. That's by institutions. So it'll cluster and it'll chasm and rapidly go, and your crossovers came in and your alerts came in and you got in right here, and it just stalls. They don't have anything against you. They're not trying to trap you. They're not trying to catch you. They're not trying to get you stuck and trick retail. They don't care. They don't have to. This is very predictable if you understand how to follow institutions. Retailers are about chasms and verticals. They are. And there's nothing wrong with that. You just have to know, how long is the vertical going to go to? What's the next auction zone? How far can I ride this thing before it's going to slam into another clustering zone? Okay. Sometimes it chasms right up to the next clustering zone and goes nowhere, clusters. And you're getting in hoping it keeps going, and it doesn't. Okay. That auction zones framework allows you to make good high-level professional type decisions, and it changes everything for you. Like my friend Joseph, who again is making $50,000 per month. Okay. John took it to the next level. He says, once you have the zones, how do you trade them? That's the next level. Okay. That's the next level of this is, okay, I can see that, yeah, that's where my highs and my lows are happening. You trade level to level, John. Okay, you trade level to level. If I'm rising up into this area, I'm assuming it's going to hold as resistance until it doesn't. Once it doesn't, it's now a breakout situation that's going to likely come up into this zone, and I'm trading it that way. There is a whole slew of things that goes into the way that we trade those zones. We've got a whole slew of rules that we follow and the amount of risk that we put on for each position. But you're just trading level to level. If you drop down into a zone, you're assuming it's going to hold as support. If it's breaking down below, you're getting out, simply put. You know, it's like any other indicator that you're using, except this one is actually showing you how the market actually trades. I know where that high could potentially be. It's at an auction zone. Okay, right in an auction zone, right in an auction zone, right in an auction zone. I don't need to wait for these things to pass. I can see these things coming up on my radar and operate at a high level within them. All right. Matt says auction zone, great clarity, very professional. Thank you, Matt. Matt says built-in target price. That's exactly right. Built-in target prices. Wisdom is in the simplicity. Yeah, thank you so much. I hope that it was. So yeah, I mean, this is the thing that you don't have to have a lot of money to operate in the market. You have to have a framework that allows you to ultimately earn a lot of money and have a high accuracy rate. And that's what my friend Joseph did. He sent me these results. I mean, the guy's having $100,000 a month. Okay. Now, this is just written down on a PowerPoint, but this is not unusual. I mean, here's just a screenshot of my platform. Okay. It's an $88,000 day. All right. I think yesterday we had again, same thing. You know, this isn't on a large account. It's a $155,000 account. Okay. Yesterday, let me just pull that up real quick. Where is it at? I think I have it right here. Okay, right here. Here's one of my accounts, Nick Lovelace. It's not a big account, but it's a great day. Okay. Following institutions changes everything for you. Following the smart money changes everything for you. All right. So you can see why we're not cheap. Okay. We're not 79 bucks a month, but it is an ATM what we do. All right. Very radically predictable. And it's the last thing you'll ever need to do. If you've never had success before, this will work for you because you're following the smart money. The institutions that move the market, you're following them. So how can I help? My team and I, what we've done is we've set aside some time over the next 48 hours to speak with you personally about how you can apply these ideas to your trading today. Whatever your biggest challenges are, we've seen it, we know how to overcome it. So what we'll do on this session, and I'll tell you the cost of it here in just a moment, is we're going to work with you one-on-one to craft a step-by-step game plan to hit your income goals for the next year, whether that's $10,000 a month or $200,000 a month, and how to become a master at getting in and out of positions at the right time by following auction zones. So this is who this is for. The cost of it is free. We don't have unlimited spots. So this is who it's for. Generally, you just need to have some idea of the market in general. You've got to have already taken some prior education, tried this for a little bit, and are still struggling to find consistent, predictable success. In our experience, brand new people don't know what they don't know, and sometimes they have a hard time following rules. All right. But people that have been around the block a little bit are really easy for us to take by the hand and change everything for them. All right. Matt's goals are 100 to 800,000 per day. I love it, Matt. You think it's crazy, but we've had those kinds of days. So if you take one of these slots, show up to the call, have integrity, If that's you, we've got 5 slots open right now for that one-on-one call. Go there now and do that. We'll put it in the chat here in just a moment. So this is why we're doing it. Number one, I don't like this industry. It's our mission to kind of merge the institutional side and provide traders with a professional grade system, and not just another retail operation. But we also know that you may want our help to transform your trading. And if so, we can discuss that, see if it's a good fit for both of us. If not, that's fine too. The call is still free. So I said we have 5 slots. Yeah, I'll be taking, I'll hop on some of those calls. We've got 5 slots open right now, thesupertrader.com/chat. /chat. I think I've got 2 minutes of Q&A here. Manasseh says I'm in. Book that slot, Manasseh, and save it. All right, what questions do you have for me? What questions do you have for me? Juliana, go book that slot, thesupertrader.com/chat. I'll put it in the...
I put it in the chat.
Did you? Okay, awesome.
Yep. I put your email up there as well.
Okay, great. So what questions do you guys have for me? What questions do you guys have for me? Any questions I can answer for you? So in the end, I love to start end where I finished with Ray Dalio's story. In retrospect, my crash or failure was one of the best things that ever happened to me. I saw that to do exceptionally well, you have to push your limits. That if you push your limits, you will crash and will hurt a lot. You'll think you failed, but that won't be true unless you give up. I hope no matter what you've been through in your journey, that you won't give up. Recognize there are good people out there that can help, and this can work for you. And I hope that in some way you've taken something from my presentation. It's been an honor to be with you here today, and I know you've had a long day. We provide those zones for you, but we also teach you how to do it yourself. Bob, Fred says, does it work with futures and Forex? Yes, it does. Forex is so liquid that it's hard to even see institutions on there. So it's not as great on Forex, but like I say, it's not, I don't care what I'm trading. I just want it to be predictable. And following institutions, in my opinion, is the best way to predict. Oh, you bet. My pleasure there, Fred. My pleasure. Can mobile trading work or it requires a PC? Yeah, mobile trading works just fine. We do it all the time. We do it all the time. Any other questions you guys have for me? Man, you guys are just absolute rock stars for sticking around for 4 hours, and we still have like a full room, Sherry.
Just 3
So
hours.
Either they're okay, 3 hours. My bad. Either they're all
yes,
asleep,
they
or
are the
they're just
intrepid ones.
That's awesome.
Well, I think those slots are going to go fast. And I think everybody on this call should absolutely go and take advantage of that. And Nick, for anyone who's watching this on replay, will those be available? Like if they don't all fill up now, which I can't imagine, but if they don't all fill up now and someone watches this tomorrow, can they can go to that chat, that link and try to get a time booked, right?
They can. We've got 5 slots available right now. If we really fill those up quickly, we'll open up a couple of more. But Matt, I've got you in. Manasseh, I've got you in. Richard, I've got you in. Already, I've got you in.
Oh, that's
Matt,
5, isn't it?
Matt, I've got you in. Matt just asked in the chat if he's in. So you're in, Matt. I got you on the calendar. So yeah, we've got one of those slots open right now. We'll open up a couple of more, Sherry.
Okay, great, because we get a lot of people who come and watch the replay for sure.
Yep.
So we like that. We love everybody who has stayed till the end here. Thank you so much for being with us. I really appreciate it. And I hope you'll come back again.
Absolutely. Thanks for having me, Sherry.
All right. You have a wonderful day. All right, folks, guess what? It's that time of the day. We want to thank you so much for being here. And I really want to thank my speakers for taking the time out of their day to come and teach us and share with us. We're really blessed to have the people who come and take part in these series sessions. That was Nick Lovelace with the Super Trader. Take advantage of the links in the chat. This was a presentation of tradersexclusive.com. Our Twitter is options_info. And I hope everybody has a great day. We're going to be doing this again on August 17th, so keep an eye out for that. And from all of us here at Traders Exclusive, trade well. Have a good day.